a recess of the committee at any time without objection. All members shall have 5 legislative days within which to submit additional materials to the chair for inclusion in the record. We'll now proceed to today's business. The chair will recognize himself for an opening statement. Last year was an active and productive year for our committee. We favorably reported 60 bills to the House. 43 bills were considered on the House floor, and all 43 passed with bipartisan support. 28 bills actually reached the president's desk and were acted into law. In an era of divided government, not a bad record. So we started our first legislative markup in 2016. I want to commend members on both sides of the aisle for working on a bipartisan basis during the last year. And although I'm not oblivious to the fact that it is an election year, I hope that we can continue in today's markup in having more bipartisan legislation sent to the president's desk, for we have much work to do on behalf of the American people. Today we have an agenda with 10 bills, all of which are designed to grow our economy, provide hardworking Americans with greater economic freedom. And I would be remiss if I didn't point out that one of my daughter's favorite stars, Kanye West, recently reminded us, quote, "The only true freedom is economic freedom." I do that for the benefit of my daughter. Let me briefly review the bills today. I believe most of us would agree that our economy works better for all Americans when small business can focus on creating jobs rather than navigating bureaucratic red tape. That's the idea behind the Fostering Innovation Act, the bipartisan bill sponsored by Ms. Sinema and Mr. Fitzpatrick, which would reduce compliance costs for growing businesses that benefited from the Jobs Act in 2012. Another needed bipartisan reform is the Expanding Proven Financing for American Employers Act, sponsored by Mr. Barr and Mr. Scott. Changes in this bill will ensure job creators on Main Street are able to obtain the affordable financing that's essential to job growth. In a climate of uncertainty brought about by a lot of complicated Washington regulations that harm our economy and can destroy opportunities for growth, we'll consider several bipartisan ideas that will bring common sense to Washington rulemaking. The Bipartisan Investor Clarity and Bank Parity Act, sponsored by Mr. Capuano and Mr. Stivers, makes a technical modification to regulation in order to ensure Main Street businesses and banks have access to affordable financing and growth capital that they need. In both the HALOS Act, Helping Angels Lead Our Startups, sponsored by Chairman Shabbat of the Small Business Committee and Ms. Sinema and Mr. Hurd of our committee, and Mr. Garrett's Main Street Growth Act will help ignite the entrepreneurial spirit by helping small businesses attract investments so that they can open their doors even wider. We've heard from countless witnesses who tell us that small community banks and credit unions, which had nothing to do with the financial crisis, desperately need relief from regulations designed for big banks. We know that services customers once took for granted, like free checking, are being eliminated because of the cost and complexity of these burdensome regulations. Under bipartisan legislation we'll consider today, sponsored by Mr. Tipton and co-sponsored by Mr. Perlmutter, federal regulators will be required to tailor regulations to fit the diversity of financial institutions instead of wantonly imposing inefficient and damaging one-size-fits-all regulations that harm consumers and are suffocating their hometown banks and credit unions. While protecting community financial institutions and their customers from Washington's unfair regulatory assault, we'll also discuss legislation to protect the vital due process rights of defendants in proceedings before the Securities and Exchange Commission. Mr. Garrett has introduced the Due Process Restoration Act, which gives defendants the option of having their cases heard before a federal court rather than being forced to appear before the SEC's in-house justices. We'll also give options to homeowners at lower cost when it comes to flood insurance with the Flood Insurance Market Parity and Modernization Act, another bipartisan bill that is sponsored by Mr. Ross and Mr. Murphy. Again, this bipartisan bill will remove unreasonable regulatory barriers that are hindering homeowners' flood insurance options. There's no doubt that the National Flood Insurance Program is badly in need of reform. It is $23 billion in debt to the taxpayers. It is unsustainable. It hinders the development of a private competitive flood insurance market. which would give homeowners more choices, lower costs, and protect hardworking taxpayers from more bailouts. Finally, we have two other bills on the agenda: the Safe Transitional Licensing Act, sponsored by Mr. Stivers and Ms. Sewell. Again, a bipartisan act creating a 120-day grace period during which licensed mortgage originators retain the right to continue originating loans when they change jobs. And Mr. Hill is sponsoring the Preserving Access to Capital Act, which makes very modest changes to risk retention rules, providing relief for certain commercial real estate loans that provide economic growth. The members of this committee, again, are to be commended for working together in a bipartisan manner to identify problems that create economic uncertainty, stifle growth, and for developing solutions to those problems. Finally, I would be remiss if I didn't wish everybody a happy Texas Independence Day for all the Texans on the committee and for those who wish they were. Now the chair recognizes the ranking member for her opening comments.
Thank you very much, Mr. Chairman, for hosting this markup this morning. Today, we gather to discuss 10 pieces of legislation that span the gamut of our capital markets, banking regulatory system, and the way that Americans purchase flood insurance. While some of these proposals are modest or incremental in nature, seeking in good faith to make improvements to existing law, the vast majority of bills we will consider today represent the next phase of a coordinated attack on the proper functioning of our financial markets. Whether it is undermining the structure and independence of the Consumer Financial Protection Bureau, denying proper funding for the Securities and Exchange Commission, or deregulating of our largest banks, the majority has been bent on using this committee to undo the important work we crafted in the wake of the 2008 financial crisis. And soon, on the House floor, I fear there will be attempts to gut the administration's rule to rein in conflicted retirement advice, as well as efforts to once again use the budget to undermine protections for mortgage borrowers, payday customers, service members, and students. The American people, on a strong bipartisan basis, broadly favor efforts to properly regulate the financial services sector. When we use this committee to advance the needs of special interests rather than working people, we squander the trust of the public and fail in our obligation to protect the least of these. So far, we've seen dozens upon dozens of piecemeal bills looking to undermine financial reform, either under the guise of capital formation or somehow giving consumers the freedom to access harmful financial products. And soon, if press reports are any indication, the majority will switch gears and work to repeal sections of Dodd-Frank entirely, including the Volcker Rule and the creation of the Financial Stability Oversight Council. And while we continue to churn out bills that are not well-crafted or arrived at in a thoughtful, bipartisan manner, our Republican counterparts in the Senate refuse to do their jobs. In fact, despite months and months of waiting, the Senate majority refuses to consider nominees for key posts, from the SEC to the Federal Reserve to oversight of terrorism and financial crimes at the Treasury Department. That, of course, is not even addressing the vacancy on the Supreme Court. Finally, Mr. Chairman, let me say that I'm disappointed that while we continue to spend countless hours on this committee on attempts to undermine Dodd-Frank, we neglect the issues that present the most pressing challenges for our country, including and especially homelessness in America. For example, Mr. Chairman, are you aware of the fact that we currently have 600,000 people in this country who are homeless? And are you aware that of those people, that over 173,000 of them are basically unsheltered? These are people who are staying in places not meant for human habitation, including the streets, abandoned buildings, vehicles, and parks. And are you aware of the fact that homelessness in several major cities has increased, with homelessness in Los Angeles growing by a staggering 20% in just 1 year. Despite being asked by nearly every Democratic member of this committee to hold a series of hearings on the state of homelessness in America, we have not held one single hearing on the issue. While we continue to churn out bills on this committee whose consequences are not well thought out, we fail to properly address the dire, abject poverty facing too many of our fellow Americans. Well, with that, thank you, Mr. Chairman. I yield back the balance of my time, and happy Independence Day.
Thank you. Now pursuant to notice, I call up H.R. 2901. The clerk will report the bill which was distributed in advance.
H.R. 2901 to amend the Flood Disaster Protection Act of 1973.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Florida, Mr. Ross, to offer an amendment in the nature of a substitute. Does the gentleman have an amendment at the desk?
Yes, sir.
Copies of the amendment have already been distributed and are on the dais. The clerk will report.
Amendment in the nature of substitute offered by Mr. Ross. Strike all after the enacting clause and insert the following. Section 1.
Without
short
objection, the
title.
amendment is considered read and will serve as base text for purposes of amendment. The gentleman from Florida is recognized for 5 minutes.
Thank you, Mr. Chairman. Providing American homeowners and business owners more affordable consumer options in the flood insurance marketplace has been one of my top priorities since I was elected to represent Central Florida in the Tampa Bay region in our nation's capital. Floridians and all Americans across the country would greatly benefit from more choices when it comes to flood insurance policies, and private competition in this market will lead to greater innovation and more affordable and comprehensive policies for consumers. Unfortunately, regulatory barriers and the bias of regulators favoring the National Flood Insurance Program policies have prevented the development of a private flood insurance marketplace. This was not the intention of Biggert Waters. Rather, it was an unintended consequence. With that in mind, I worked with my colleague, Representative Patrick Murphy, to introduce H.R. 2901, the Flood Insurance Market Parity and Modernization Act. This bipartisan legislation will remove the unnecessary regulatory barriers that are hindering consumers' flood insurance options. Specifically, this legislation would require federal agencies to accept private flood insurance that complies with the laws and regulations of the state of an insured property. Under current law, consumers are severely limited to coverage options provided by the NFIP. For example, an NFIP policy only covers up to $250,000 of damages related to residential home. Also, NFIP policy does not cover homeowners' living expenses such as temporary housing if they are displaced by a flood. In the case of a business, the NFIP policy does not provide coverage for the financial losses suffered by a business as a result of the flood. While the NFIP is limited in what their policies can cover, the private sector is not. The private sector is also in a better position to provide stronger incentives for property owners to invest in mitigation and resiliency. Ultimately, this increased emphasis on mitigation will benefit homeowners and taxpayers alike. The Flood Insurance Market Parity and Modernization Act encourages the development of a robust private flood insurance market that can offer property owners multiple options in terms of pricing and coverage. Ultimately, the consumer is the benefactor of increased competition and options in this marketplace. I want to take a moment to thank you, Chairman, and my subcommittee chairman, Blaine Luetkemeyer, for their support of this legislation and their leadership on this important issue. Finally, I also want to thank the ranking member, Mrs. Waters, for working with me through this entire process. I greatly appreciate your assistance, as do the residents of my home state of Florida. With that, I urge my colleagues on both sides of the aisle to join me in enacting this common-sense, bipartisan legislation that will encourage the expansion of a well-regulated, more affordable private flood option for homeowners. With that, I yield back.
Gentleman yields back. Who seeks recognition? For what purpose? The gentleman from Florida seek recognition. Gentleman is recognized for 5 minutes.
Well, thank you, Mr. Chairman and Ranking Member Waters, for bringing this legislation to the committee today on a bipartisan basis. This legislation, the Flood Insurance Market Parity and Modernization Act, which I proposed with my good friend and fellow Floridian, Mr. Dennis Ross, will level the playing field in the flood insurance marketplace and provide an opportunity for the private sector to offer flood insurance policies that meet the coverage requirements set for the National Flood Insurance Program. It provides needed clarity that flood insurance, other than that which is offered by the federal government, may be an option available to homeowners, as was intended by Biggert Waters' Flood Insurance Reform Act of 2012. Biggert Waters contained numerous reforms to the NFIP, including to oblige lenders to accept private flood insurance for purposes of the NFIP's mandatory purchase requirements if flood insurance meets the same coverage required for NFIP insurance. However, lack of clarity in the law's definition of private flood insurance permitted for this purpose has caused lenders to be unsure about the validity of privately issued flood insurance, and they have refused to accept private flood insurance for mandatory coverage under NFIP, even though this insurance has been issued and accepted in the past. This bill will solve this problem by providing a simple and clear definition of the private flood insurance accepted for mandatory coverage under the program, consistent with the time-tested and successful regulation of all other property and casualty insurance. That which complies with the law of the state in which the insured property is located and is issued by an insurance company licensed, admitted, or otherwise approved to engage in the business of insurance in that state. Private insurers are already subject to statutes and regulations in every state, and state insurance commissioners have long been considered by Congress to be the best regulators to allow or disallow insurance, including insurance intended to protect property in the event of a disaster. Ensuring access to private flood insurance choices will help reduce the risk to which taxpayers are exposed under the NFIP in the course of flooding events, and especially because flood insurance coverage is mandatory in many areas, customers need more competition and options in the flood market to make it more affordable. This bill does not create preferences either for government or private sector flood insurance products. It does, however, affirm the intent of Biggert-Waters that private flood insurance may serve as an optional consumer alternative to federal government products. I thank Ranking Member Waters and her staff for working with Representative Ross and I on ways in which to improve this bill, and very pleased that the final product of a process that can serve as another example of how members on this committee can come together to find common ground to solve problems for our constituents. I want to give a special thank you to Congressman Ross for his time and work over the past several months or year on this issue, because it's something very important to both of us, but more importantly to our constituents. So I ask that my colleagues on both sides of the aisle support this legislation to give our people more choice, greater competition, and ultimately less cost when it comes to flood insurance. I yield the balance of my time.
Gentleman yields back. For what purposes, gentlemen from Missouri seek recognition?
Mr. Chairman, I move to strike last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I want to start by thanking the gentleman from Florida, Mr. Ross and Mr. Murphy, for their hard work on this legislation. H.R. 2901 is a common-sense, bipartisan down payment on reasonable reform of the National Flood Insurance Program. This legislation would make an important clarification that flood insurance offered by a private carrier can satisfy the NFIP mandatory purchase requirement. Our ultimate objective in any NFIP reform should be to deliver greater choice and opportunity to the customer. H.R. 2901 would take the first step in meeting that objective by encouraging the development of a stronger flood insurance market. Legislation would preserve the consumer's ability to find the policy that best fits their needs. It does not steer policyholders away from the NFIP, but rather affords them options to purchase private coverage. The legislation includes safeguards that allow a consumer to return to the NFIP if he or she is dissatisfied with that private coverage. NFIP has existed for nearly 50 years with little improvement or modernization. This is a program that's in need of serious reform, and I'm pleased that the members of this committee are willing to engage in these conversations on a bipartisan basis. The bottom line is that the current NFIP construct doesn't serve our constituents. It's an outdated system that offers inadequate coverage at a cost to all U.S. taxpayers. We deserve more and can do better. I commend the gentleman from Florida for their continued leadership on the issue and look forward to working with them on future NFIP reform endeavors. I ask my colleagues to support me and join me in supporting H.R. 2901, and yield back the balance of my time.
Would you yield to the chairman?
I'll yield back to the chairman, yes.
I thank the gentleman for yielding. I, too, wish to commend both gentlemen from Florida. I know that they have labored on this bipartisan product for many, many months now. It was not necessarily easy labor, but it was fruitful labor. We all know that the National Flood Insurance Program is $23 billion underwater, pun intended. And we know that this committee has some serious work next year as it comes up for reauthorization. But we can't wait to help the people who use flood insurance. We can't help to wait the taxpayers, to wait in order to help the taxpayers. So I just want to thank both gentlemen. I also want to thank the gentleman for Missouri. It's his committee that produced this product, and again, for producing a very strong, significant bipartisan legislation. I urge all members to adopt this. Again, all we're doing is creating more choices, more options, hopefully greater innovation and price competition. No customer is going to be forced to buy another product, but at least they will have options. And ultimately, it is options that create the innovation and the price competition that really affords our greatest consumer protection. So I urge all members to adopt this. I yield back to the gentleman from Missouri.
yield
who I
back to the
assume
chairman.
yields back. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady's recognized for 5 minutes.
Mr. Chairman, first, I'd like to thank Mr. Ross and Mr. Murphy for thanking me. This is unusual to have a thank you from both sides of the aisle. And I'm so pleased that we were able to come together across the aisle and work on this bill in a bipartisan manner. And to you, Mr. Chairman, despite my criticisms in my opening remarks, I'm very pleased about our ability to come together and work on this bill. And of course, again, I certainly commend the sponsors of this legislation, Mr. Murphy and Mr. Ross, for their work. And I'm pleased that they were willing to make some changes to address a few concerns that I had with this otherwise thoughtful piece of legislation. First, we made sure to maintain adequate federal oversight. The federal mandatory purchase requirement is as much about protecting borrowers as it is about protecting our federal banking and housing regulators and the U.S. taxpayer. Our regulators need authority to set necessary requirements on the financial strength of the private companies from which they will be required to accept coverage, and I'm pleased we were able to add in that clarifying language. Second, we included some important consumer disclosures that, for example, disclose to borrowers the potential differences between a policy provided under the National Flood Insurance Program and a private policy. Specifically, the disclosures encourage borrowers to be mindful of differences such as coverage amounts, deductible levels, exclusions, conditions, and premiums. And so, with these changes, I'm prepared to support this bill. It is my hope we can continue in this bipartisan spirit as we consider the upcoming reauthorization of the National Flood Insurance Program. I believe that it is absolutely critical that we prioritize thinking about this program and how we can improve it for the long term while keeping premiums affordable. First, Congress must get serious about the National Flood Insurance Program's debt. We all know that the NFIP is billions of dollars in debt. But what we may not know is that the NFIP's debt will continue to threaten the affordability of premiums and the long-term stability of the program. We must start this next reauthorization with a clean slate. And I dare to step way outside of the box and say we should wipe out the NFIP's debt. If we don't act, affordability of premiums and stability of the program will be unachievable. We must also address the high cost of disaster assistance. Studies have indicated that taxpayers are paying a greater share of disaster costs today than ever before. These disasters are not just limited to flooding, but occur all across this nation in the form of tornadoes, earthquakes, wildfires, and so on. Rather than continue to increase the amount of federal dollars spent after disaster strikes, Congress should prioritize investment of federal dollars in building resilient and sustainable communities before the storm hits. I stand ready to work across the aisle to ensure that the NFIP remains able to provide affordable flood insurance and perhaps even broader coverage so that our nation is resilient in the event of a disaster. Mr. Chairman and members, I really do believe that I have a real stake in the reauthorization of our National Flood Insurance Program. As you know, I'm the waters of the Biggert-Waters bill, and I talked about the unintended consequences and worked very hard on the Home Affordability Insurance Act. And we have until next year to come up with something that makes good sense. And so not only are we going to work very hard, we really do believe that this is a real opportunity for us to work together across the aisle to get something done. And I certainly believe that we can. And I know that with Mr. Lukemeyer providing some leadership, working with you, Mr. Chairman, that we will be looking at mapping and all of the other obstacles that have stood in the way of us having a really credible national flood insurance program. So I eagerly look forward to the opportunity to work with you on this issue, and I yield back the balance of my time.
For what purpose, the gentleman from North Carolina seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Today, I urge my colleagues to join me in support of H.R. 2901, the Flood Insurance Market Parity and Modernization Act of 2015, which will increase competition in the flood insurance and marketplace, provide hardworking Americans with a real choice. I congratulate Congressman Ross and Congressman Murphy on this market-driven legislation. Current law and, unsurprisingly, an increasingly amount of bureaucracy and regulation have prevented the development of a private flood insurance market, meaning ordinary Americans have only one choice for flood insurance: the ever-present federal government through the National Flood Insurance Program. As of now, the NFIP is not an ideal model for providing residential and commercial property owners with effective protection from flood damages. H.R. 2901 would encourage and facilitate the creation of a private market for flood insurance and also allow insurers to work directly with their state commissioners to develop common sense policies that actually work for their customers, not more one-size-fits-all. The continuous coverage provision will allow homeowners to go back and forth between NFIP and private insurance, providing an important backstop that will keep homeowners from being stranded should rates in the private sector suddenly increase after a major flood. H.R. 2901 is about consumer choice and simply allows customers to explore policies in the surplus lines market if they choose to do so. This legislation is a solid first step in the development of a private market options for property owners. And I commend, again, Congressman Ross and Congressman Murphy for introducing this strong legislation. Thank you, Mr. Chairman, and I yield back.
Gentleman yields back. Who seeks recognition? For what purpose does the gentleman from Pennsylvania seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I thank the chairman for yielding, and I would also like to commend Representative Ross and Representative Murphy for their hard work on this important issue. Although many tend to think of flood insurance as a concern for coastal states like Florida, Louisiana, and Texas, it is important to note that many Pennsylvanians are closely monitoring the ongoing debate about the future of flood insurance taking place at this committee. Many of my constituents live alongside rivers and streams and in valleys with a history of flooding. For instance, the city of Johnstown, which anchors the eastern part of my district, has a terrible history of devastating floods. The most recent Johnstown flood in 1977 killed 78 people, destroyed over 500 houses, and severely damaged over 5,000 other residential units. My district is home to many older cities and towns like Johnstown that are filled with properties that predate the NFIP. People have lived in these places for generations and have a deep sense of community. Rightly, my constituents who live in these flood-prone areas worry about the future availability of affordable flood insurance options in the marketplace. They want to remain in their homes, in the places where multiple generations of their families have lived and worked and built lasting connections with their neighbors. My constituents need access to affordable flood insurance, and as this debate continues over the next year, I will make sure that my constituents' concerns are addressed. H.R. 2901 is a strong step in the right direction as we seek to reform federal flood insurance policy. This bill paves the way for greater private sector involvement in the flood insurance industry, which will increase choice and competition. Under this pro-consumer legislation, my constituents will be able to purchase the flood insurance policies that work best for them. These may be less costly plans, or they might be packages that offer other valuable features to property owners that are not available through NFIP. As consumers begin to gravitate towards privately provided flood insurance, taxpayer exposure to flood insurance losses will be diminished. This is vitally important as the NFIP, as it currently is constituted, is unsustainable. I look forward to working with my colleagues on this committee to pass this legislation and bring about these much-needed flood insurance reforms. I thank the chairman, and I yield back.
Who seeks recognition? Gentleman yields back. For what purpose does gentleman from Texas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to my friends Mr. Ross and Mr. Murphy for introducing this common sense legislation. H.R. 2901, the Flood Insurance Market Parity and Modernization Act of 2015, will clarify that flood insurance offered by a private carrier outside the NFIP can satisfy mandatory purchase requirements as defined by the Flood Disaster Protection Act. Mr. Chairman, as we've heard this morning, the NFIP program is in trouble and in need of real reforms. Highly leveraged and poorly capitalized, the NFIP program is in danger of breaching its borrowing authority. With the passage of H.R. 2901 and greater participation by the private sector, my hope is that we can help reduce taxpayer exposure and liability. While this bill might not solve the program's long-term problems, H.R. 2901 is certainly a step in the right direction. In January of this year, members of the Subcommittee on Housing and Insurance heard testimony about the often confusing definition that exists in the private flood insurance market, with lenders often rejecting private flood insurance due to uncertainty. H.R. 2901 aims to correct that. In addition, H.R. 2901 will give state regulators the flexibility to approve private flood insurance coverage, while will promote consumer choice and competition in a market that lacks both. Mr. Chairman, I urge passage of H.R. 2901, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from Florida. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it.
Mr. Chairman?
For what purpose does the gentleman from Florida seek recognition?
Mr. Chairman, I request a recorded vote.
A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 2121. The clerk will report the bill which was distributed in advance.
H.R. 2121, to amend the Safe Mortgage Licensing Act of 2008 to provide a temporary license for...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Ohio, Mr. Stivers, to offer an amendment in the nature of substitute. Does the gentleman have the amendment at the desk?
Yes, Mr. Chairman.
Copies of the amendment have been distributed and are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. Stivers. Strike all after the
Without
enacting
objection,
clause.
the amendment is considered as read and will serve as base text for purposes of amendment. The gentleman from Ohio is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate your willingness to have a markup on this bill. I also appreciate my Democrat colleagues, Ms. Sewell and Ms. Beatty, for their work on this common sense bill. And in keeping with our new tradition, I'd like to thank the ranking member for her work and agreeable nature on this bill as well. The SAFE Act passed in 2008 as part of the Housing and Economic Recovery Act. It created two different sets of standards for qualification of residential of mortgage loan originators, depending on whether that mortgage loan originator worked for a state licensed non-depository or a federally regulated depository. The problem with that has resulted when people want to leave a federally regulated depository and go to a state regulated non-depository, and the result today is those people have to stop working while their applications are being processed. This bill, H.R. 2121, is a bipartisan bill that will ensure people working as mortgage loan originators at depository institutions are able to move to non-depository institutions with a minimal amount of disruption. This is a jobs issue. Individuals shouldn't be prevented from working for weeks or even months because they want to change jobs from one employer to another. Representative Sewell and Beatty and I worked with industry, with stakeholders, with state regulators to improve this bill, And HR 2121 as amended will foster an efficient marketplace and competition between banks and non-banks that will allow mortgage loan originators to help the American people achieve their dreams of home ownership. I'd like to quickly walk through the amendment in the nature of a substitute. It provides mortgage loan originators a transitional authority to originate if they move from a depository institution to a non-depository state regulated entity. Under the proposal, an individual who's employed by a financial institution and has been a registered loan originator under the SAFE Act for the preceding 12 months may continue to originate loans after submitting their background check, credit information to the state, along with an application until that application is either approved, denied, withdrawn, or deemed incomplete. These mortgage loan originators are eligible for temporary authority so that they can continue to work and continue originating loans to help the people they serve. And it will only happen as long as they previously have not been denied an application, had an application revoked, a license revoked or suspended, or been subject to a cease and desist order. Also, if they've been convicted of any felony that would preclude them from licensure, they also are denied this temporary authority. Similarly, a state licensed loan originator in one state who takes a position in another state may be granted that same transitional authority. In my district, we're just 10 miles from both the Kentucky and West Virginia line, and some people might want to move in situations like that where they're close to a state line and move to an employer on the other side of the state line. In both instances, the temporary transitional authority expires after granting of the license, withdrawal, denial of the application, or 120 days if the application is incomplete. So that's what the amendment in the nature of a substitute does. We worked with all the interested parties. Again, I want to thank Representative Sewell, Representative Beatty, and the ranking member for all their work on this. And I yield back the balance of my time, Mr. Chairman.
The gentleman yields back. Who seeks recognition? For what purpose does gentlelady from Alabama seek recognition?
I move to strike the last word.
Gentlelady's recognized for 5 minutes.
Mr. Chairman, today I rise in support of the amendment in the nature of a substitute for H.R. 2121, the Safe Transitional Licensing Act of 2015. I am proud to serve as an original Democratic co-sponsor of H.R. 2121, and I really want to applaud my colleague, Representative Stivers of Ohio, for working in a bipartisan way to draft this critically important piece of legislation that we are considering today. H.R. 2121 helps facilitate a loan originator's job mobility while ensuring that state regulators continue to have the ability to protect consumers and the marketplace. This legislation offers a narrowly tailored and pragmatic solution that provides a transitional authority to originate mortgages for individuals who move from a federally insured institution to a non-bank lender. During this transition, these individuals will also work to meet the SAFE Act's licensing and testing requirements. Over the past several years, state legislators, regulators, key industry stakeholders, and members of Congress have been engaged in an extensive dialogue on ways to eliminate job barriers for loan originators, as well as to help promote home ownership for qualified borrowers. H.R. 2121 is truly a reflection of what can be achieved when we all work together towards a unified and shared goal. Again, I want to thank my colleagues, Representative Stivers and Representative Beatty, for all their hard work on this bipartisan piece of legislation. I urge my colleagues to support the amendment in the nature of a substitute of H.R. 2121 and yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? For what purpose does gentlelady from Ohio seek recognition?
Move to strike the last word.
Gentlelady's recognized for 5 minutes.
Mr. Chairman, Ranking Member, let me simply say I'm proud to associate myself with the words of Congressman Steve Stivers and Congresswoman Terry Sewell, and I think this is a good example of how we can not only work together in a bipartisan fashion, but we can do it and make a difference in the laws that we craft. Thank you, Mr. Chairman.
Gentlelady
I
yields-
yield back.
Gentlelady yields back. Who seeks recognition? For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
Gentleman recognized for 5 minutes.
Thank you, Mr. Chairman, and I also lend my support to the amendment in the nature of substitute for H.R. 2121, the Safe Transitional Licensing Act, and I would thank my friend Congressman Stivers for introducing this common sense bipartisan legislation. Under the SAFE Act, which was passed in 2008, originators working for banks and credit unions subject to federal oversight must register with the National Mortgage Licensing System and Registry. Originators with non-depository mortgage companies are required to be licensed at the state level, subject to state regulation that may expand on federal standards mandating continuing education training, the passage of a federal criminal background check, and other requirements. As a result, there is an inconsistency between the licensing requirements for two people doing substantively identical jobs. One, an originator for a federally regulated depository, the other as an originator for a state-regulated non-depository. So life generally can't wait for a bureaucracy, and I'm a firm believer that we need to facilitate the free movement of labor around the country for the good of the national economy, but also to allow people to pursue their own prosperity. So Congressman Stivers' bill will help people in the mortgage origination field do just that. It's a targeted bill, and it would grant a temporary 120 days for originators moving between states or from a federally regulated depository to a state-regulated non-depository so that they can immediately begin working for their new employer and not put their lives on hold. So it is a common-sense solution, and I thank the gentleman from Ohio for his thoughtful legislation, which is endorsed by the Council of State Bank Supervisors representing state regulators themselves, and I look forward to the passage of this bipartisan legislation. Yield back.
Will the gentleman yield to the chairman? I thank the gentleman for yielding. I just wish to commend the gentleman from Ohio, the gentlelady from Alabama, the gentlelady from Ohio, working on a bipartisan basis on a very common sense bill that will ensure those who are originating mortgages do not necessarily lose their employ simply because they move institutions or perhaps move across state lines. It also makes sense for those who believe home ownership is part of their American dream. They will have greater choices, a more efficient, more competitive marketplace. Finally, nothing says support you, I support you quite like brevity, so I yield back to the gentleman from Kentucky, who I assume yields back.
And I will yield back as well.
Yields back as well. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady's recognized for 5 minutes.
Mr. Chairman, I would urge my colleagues to support H.R. 2121, the Safe Transitional Licensing Act. H.R. 2121 is a modest bipartisan regulatory relief proposal that provides flexibility to mortgage originators that transition jobs between bank and non-bank mortgage originators or that transition to mortgage originators in other states. Under current law, mortgage originators are often unable to originate mortgages if they take a new job in another state or if they move from a non-bank mortgage lender to a bank mortgage lender. H.R. 2121 establishes a framework for transitional authority, allowing mortgage originators an opportunity to obtain a transitional license for a period not to exceed 120 days while they seek a permanent state license. H.R. 2121 facilitates loan originators' job mobility while also preserving states' ability to keep bad actors out of mortgage lending, the industry, by ensuring that state regulators have clear sight lines into all mortgage originators operating within their jurisdiction. So, I'm very pleased and very happy, and I commend my colleagues, and I would urge my colleagues to support this proposal. I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs. I'm sorry. For what purpose does gentlelady from New York seek recognition? Gentlelady's recognized for 5 minutes, and I don't believe your microphone's on.
Thank you, Mr. Chairman, and thank you, Ranking Member. And I support this bill, and I am proud to have been an early co-sponsor as well. Under the SAFE Act of 2008, mortgage loan originators who work for a non-bank lender must pass a licensing test and be licensed, while a loan originator who works for a bank has only to be registered, not licensed. The reason for this is that banks are already required to have processes in place to train and monitor their loan originators. So we can assume that loan originators who work at federally chartered banks are qualified and properly trained. If they weren't, they would be in violation of the regulatory requirements of the bank. But what this dual-track system means is that when a loan originator changes jobs and moves from a bank to a non-bank, she can't actually work as a loan originator for a few months while she takes her licensing exam. This makes absolutely no sense, because when a loan originator moves from a bank to a non-bank, she doesn't lose her training or her knowledge of the application of laws. It's not as if she only knows how to properly originate loans when she's physically inside the bank. This training is portable, and she takes that knowledge with her. So in my view, there is little risk that a loan originator who moves from a bank to a non-bank lender would be originating loans improperly in the 3 or 4 months that it takes her to get the required licensing exam and get her license. And this is what this bill fixes. It provides for a temporary license for loan originators who move from a bank to a non-bank while the loan originators take the licensing exam. This is a common-sense technical fix. I applaud my colleagues, Mr. Stivers and Ms. Sewell, for their hard work, and the chairman and the ranking member, and I urge my colleagues to support it.
Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on adoption of the substitute amendment offered by the gentleman from Ohio. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. 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 All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. For what purpose the gentleman from Ohio seek recognition?
I request a recorded vote.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted.
Recorded vote.
A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 2896. The clerk will report the bill, which was distributed in advance.
H.R. 2896, to require the Federal Financial Institutions Regulatory Agency to take risk profiles and business models of institutions.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Colorado, Mr. Tipton, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman, and I'd like to thank the committee for considering this bipartisan bill, and I'd also like to extend my thanks to my colleague, Representative Barr, for his hard work on this legislation. The Taking Account of Institutions with Low Operational Risk Act requires the federal financial institutions regulatory agencies, including the Federal Reserve, the FDIC, the OCC, NCUA, and CFPB, to tailor any regulatory action occurring after enactment appropriately applying to banks and credit unions. The federal financial institutions regulatory agencies would consider the risk profile and business model of the institutions and determine the necessity, appropriateness, and impact of applying such regulatory actions to those institutions. Not only will this ensure appropriately tailored compliance obligations for banks and credit unions of various risk profiles, but the legislation will also save valuable time and resources for bank examiners. As it stands now, community banks are facing an ever-increasing regulatory burden that they can no longer shoulder. This growing burden has had a devastating impact on small banks, forcing consolidation or failure and stifling the creation of new banks in areas that need access to credit. A December 2015 report by the Dallas Fed highlighted this problem, noting that the regulatory environment is increasingly addressing big bank processes and tends to be one-size-fits-all, before concluding that the regulatory oversight should match the level of risk an institution imposes to the financial system and the economy at large. The growing compliance burden is not felt by the community banks and credit unions alone. The GAO recently released their study on the impact of Dodd-Frank, in which they found that the increase in compliance costs, has led some institutions to decrease the amount of services and products they offer, ultimately harming the communities these institutions serve. I've heard firsthand from my state. First Bank of Westminster, Colorado, shut down the majority of their mortgage group from 15 to 4 people, and some lost their jobs because of the cost of regulatory burdens because they became more expensive. A banker from Durango kept told me that Dodd-Frank has put us in a situation of not how can we help our customer, now is a question of how can we not get in trouble with compliance. Thankfully, even the regulators have begun to acknowledge this disturbing trend. Over the past year, Federal Reserve Chair Yellen, Federal Reserve Board Governor Tarullo, and FDIC Chairman Honig have all recognized and acknowledged that community banks and credit unions have been unfairly subject to supervisory trickle-down. Unfortunately, outside of these platitudes, little has actually been done to be able to alleviate the problem. The Taylor Act will stop the trend of increasing compliance costs and decreasing financial services by ensuring that regulations are tiered to the business model and risk profile of the institution. Financial institutions who are not the cause of the financial crisis will once again be able to fully serve their communities. Not only will this legislation provide relief for community banks and credit unions, but it will also allow regulators to focus their resources working with institutions that actually need attention. I urge my colleagues to support this common sense measure to provide relief for our community lending institutions. And with that, Mr. Chairman, I yield back.
Gentleman yields back. He seeks recognition. For what purpose does the gentleman from Kentucky seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman, and I would also like to register my support as an original co-sponsor of the bipartisan H.R. 2896, the Taking Account of Institutions with Low Operation Risk, or Taylor Act. And I want to thank my colleague from Colorado, Congressman Tipton, for leading the charge against inconsistent and unduly burdensome regulations on our community banks and credit unions. America has lost nearly 1,500 banks since June 30th, 2010, the last full month of data before enactment of Dodd-Frank. There have been only, in that same period of time, there have been only 3 de novo bank charters granted in that 5-year period. A 2014 survey of banks with less than $10 billion in assets found that nearly 83% of those institutions said that the costs had risen more than 5% in terms of compliance. And many have cited that the result of this increase in compliance costs means that they're eliminating certain products for their customers. Capital requirements and regulatory burdens are constraining credit, reducing the availability and affordability of home, auto, and small business loans, which obviously have negative impacts throughout the economy. Most concerning, 1/10 of these institutions anticipate being a party to a merger or acquisition in the near future. Every member of this subcommittee has heard from banks and credit unions in their communities that are facing this avalanche of new regulation and red tape. And most often, these regulations are one size fits all, and they disproportionately harm the smaller institutions that can least afford the personnel and resources necessary to comply. The Taylor Act would require federal financial regulators to take into consideration the differences in the size and scope of these institutions during the rulemaking process to prevent trickle-down regulation that may be too costly in money and resources or even unnecessary for some market participants. The bill provides transparency by requiring prudential regulators to explain the processes undertaken to design their rules to ensure that they consider the varying scales and complexities of regulated entities to avoid stifling regulatory burdens. The bill also requires the Federal Financial Institutions Examination Council to report to Congress about inconsistencies between the regulators' approaches. Regulators must be clear and transparent in explaining the goals of the regulations, the alternatives considered, and how flexibility and compliance for different institutions was preserved. This transparency will provide valuable insight into the regulatory process for Congress, for regulated entities, and the public at large to ensure regulators are conducting effective oversight where prudent, and that there is no excess red tape when regulation is unnecessary. This is important because, again, trickle-down regulation is driving consolidation in the financial services market, particularly in rural and underserved areas where community banks and credit unions can least afford these ever-increasing regulatory costs. So Shining a bit of sunlight on these processes and identifying inconsistencies between the regulators can only serve to improve the regulatory process and the health of our financial services sector. Congressman Tipton's initiative is a high priority of Kentucky banks and credit unions and their customers, and I recommend him and I commend him for his work on the bill, and I approve its approval by the committee. I yield back.
For what purpose, a gentleman yields back. For what purpose did ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Well, Mr. Chairman, we just passed out a couple of bills where there was bipartisan support, and it felt good. And I certainly would wish that we could have more bipartisan support on much more of our legislation. However, this bill does not fall into that category. The Taylor Act, I believe, is a bold attack on the Dodd-Frank financial reform law. This bill would allow every bank and financial institution overseen by agencies like the Federal Deposit Insurance Corporation or the Consumer Financial Protection Bureau to challenge rulemakings in court if they felt a regulation was not uniquely tailored to their business needs. Under this bill, financial agencies are required to ignore requirements of all other laws passed by Congress and subject all new regulations to a vague and impossible to meet standard. This includes an undefined standard of appropriateness, a vague standard of ability to flexibly serve evolving and diverse customer needs, as well as an evaluation of potential unintended impact. This set of standards not only applies to all future guidance and rulemaking, but it also retroactively applies to all of the rulemakings under the Dodd-Frank Act. The purpose of this bill is clear. By preempting all other financial law with this set of vague standards, Republicans are creating a system where every financial rule can potentially be challenged and overturned. This would have an enormous impact on important aspects of financial regulation and consumer protection. For example, under this law, banks could challenge the minimum capital requirements put in place under Section 171 of the Dodd-Frank Act, meaning capital requirements would have to be set on a bank-by-bank basis. Banks could agree under this law that they should not be subject to Fair Lending or Community Reinvestment Act rules. This bill also undermines the ability of the CFPB to regulate consumer markets on a product basis, as an institution could agree, or argue rather, that consumer protection standards for payday loans or mortgages are not appropriate for their business model or their ability to flexibly serve evolving and diverse customer needs. I'm also very concerned that this level of institution by institution tailoring could result in a severe weakening of our Anti-Money Laundering and Bank Secrecy Act rules, requiring that compliance costs and liability risks be considered at a higher priority than protecting the integrity of the financial system, could create a class of institutions with lowered compliance standards that could become a target for drug cartel money laundering or terrorist financing. Finally, the Taylor Act ignores a substantial amount of work regulatory agencies have done to ensure that rules are adopted in a way that considers the needs of smaller financial institutions. The CFPB has been very responsive to these concerns, granting a merit of exemptions and alternative compliance opportunities for smaller, less risky institutions. The FDIC and the OCC have both worked to minimize supervision and compliance burden for Dodd-Frank rulemakings, with the FDIC specifically benefiting small institutions by significantly reducing premiums for small banks. I'm happy to work with my colleagues to ensure that regulators take into account the diverse needs of smaller institutions when regulating financial markets. Unfortunately, That is not the end goal of the Taylor Act. This bill would only serve to put consumers and the entire financial system at risk by subjecting important regulations to endless litigation. Thank you, and I urge my colleagues to reject this bill. I yield back the balance of my time.
Gentlelady yields back. For what purpose? The gentleman from Texas seek recognition.
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm proud to take a brief moment this morning to support my colleague, Mr. Tipton, in his efforts to bring clarity to an often complex regulatory environment for community financial institutions. Mr. Chairman, just last week, community bankers and credit unions from our home state of Texas were in Washington to ask lawmakers for help in reducing the onslaught of federal banking regulations. This bill does that. Well, this committee has heard testimony over the last year from regulators and administration officials about the importance of small community financial institutions, how they didn't cause the financial crisis, and how they should be exempt from many of the regulations imposed on the big banks. Little action has been taken on their behalf to offer relief. In fact, just last year, Chairman Yellen stated the following: "We recognize how the burdens are on community banks, and for our own part, we are heavily focused on trying to tailor our regulations to make life better for community banks, especially those that are well-managed and have adequate capital." So, Mr. Chairman, taking Chair Yellen's own words, I believe she would be supportive of Mr. Tipton's regulations or legislation, and I urge my colleagues to vote yes, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? Chairman recognizes himself for 5 minutes. We're losing a community financial institution a day in America, and they are not dying of natural causes. They are drowning in a sea of a regulatory burden, much of which was written for larger banks. I, for one, do not believe that any bank is too big to fail, but if I did, it would be limited to about 8 or 9 money center banks, not the community financial institutions that populate so many of our districts. And we know that as they decline, the financial health of working families in our districts decline. We know that free checking at banks have been cut in half. We know that the QM rule among community banks is now known as quitting mortgages, as many of them continue to bail out of the program. We know that on revolving consumer credit, on credit cards, we've seen a 200 basis points increase in interest rates. All of the regulations, regardless of the good intent, even regardless of the good impact, they all have cost, and they are hurting working Americans. So to me, the gentleman from Colorado has come up with, frankly, a very modest bill that is a bipartisan bill. I would urge members on both sides of the aisle to support it, to try to tailor these rules so that, again, we don't see the harm ultimately to the consumers of financial products and see the harm to our local communities as we continue to lose community banks and credit unions. I was a little surprised at hearing some of the argument of the ranking member because I thought they had such trust in our regulators. I don't frankly know if the bill from the gentleman from Colorado will do that much good because, frankly, I don't trust the regulators all that much. But at least there is an option to tailor these rules for our smaller financial institutions. So when I hear the parade of horrors of the ranking member, again, these are the regulators that typically my friends on the other side of the aisle want to give so much power to. And so this would simply empower them to ensure that these rules are tailored to the appropriate financial institution. Again, I don't know the bill will help. I hope it will help. I think it could help. I know that there was also some concern about litigation. Well, in America, there ought to be some justice. There ought to be some avenue for the redress of grievances against the all-powerful state. Yes, American citizens ought to have the right to bring forth litigation where necessary. Again, it is part of assuring that we have justice in our society against the institution that has the power to coerce, the institution that has the power to fine people, to shut businesses down, to put people in jail. Yes, there ought to be some redress of grievances. So I just want to thank the gentleman from Colorado and those on the other side of the aisle who have worked with him on a bipartisan act. I frankly viewed it as a very modest act, but hopeful act for the community institution, financial institutions, again, where we're losing one a day. I commend it to all members. I hope they support it. I yield back the balance of my time. Who seeks recognition? For what purpose does the gentleman from North Carolina seek recognition?
Strike the last word.
Gentleman is recognized for 5 minutes.
I'd just like to briefly commend the congressman from Colorado for this great work. Community banks are the lifeblood of so many small communities, particularly. 47% of the loans for small business are taken from community banks, and they need every possible opportunity to continue to perform and be there for the American people. Sadly, the impact of the Dodd-Frank bill and all the regulatory environments, the compliance issues, have forced many of these banks to not be able to continue. They're consolidating, or they're not able to exist any further. So this is a kind of legislation that frankly should have the full support of this entire committee. I'm very disappointed that it doesn't, because it's so critical that we give life back to community banks. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4096. The clerk will report the bill, which was distributed in advance.
H.R. 4096 to amend the vocal rule to permit certain investment advisors.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Massachusetts, Mr. Capuano, the sponsor of the legislation, for 5 minutes.
Mr. Chairman, it's a good bill. We should vote for it. Thank you.
Again, nothing says support quite like brevity. Gentleman yields back. For what purpose does gentleman from Ohio seek recognition?
I ask to strike the last word, Mr. Chairman.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate working with my esteemed and brief colleague, Mr. Capuano, on this pretty simple bill. That's why he didn't have to speak a long time. One of the tiny provisions in the vocal rule prohibits bank holding companies and their affiliates from sharing the same name or a variation of that name for corporate marketing or promotional purposes with a private equity fund or a hedge fund. However, when federal regulators adopted their final rule to implement the vocal rule, they expanded upon the name-sharing prohibition. Specifically, the final rule provides that the covered fund may not share the same name with the banking entity or an affiliate subsidiary thereof, nor can the covered fund use the word bank in the name. Consequently, a covered fund could not use the name of its sponsor. For example, if XYZ Investment Advisors is an affiliate of XYZ Bank and sponsors a real estate fund, the real estate fund could not be named XYZ Real Estate Fund. Current regulations are at odds with both industry practices and the goal of providing clarity to investors about who's managing a covered fund. H.R. 4096 makes a very modest change to the vocal rule while still complying with current restrictions of the statute. Let me be clear, everything else in the vocal rule will apply to this covered fund. So this bipartisan bill is literally a technical amendment that would seek to clarify a narrow definition that allows sharing of names so that it's clear to investors who's managing a fund. That's a little longer explanation than my colleague, but I would urge my colleagues to support this legislation and yield back the balance of my time.
Gentleman yields back. Who seeks recognition? For what purpose does the ranking member seek recognition?
Mr. Chairman and members, I'd like to enter into the record a couple of letters, one from Americans for Financial Reform, and the other one is from Public Citizen. And let me just say that There are some concerns that have been raised. However, my staff have been working with Mr. Capuano, and we just had some conversations with some of the staff of the committee, your committee, and between now and the floor, we'll continue to talk. But I just wanted to enter that into the record at this point.
Without objection, it comes in under general leave. Who seeks recognition? For what purpose does gentleman from New Jersey seek recognition?
To briefly strike the last word.
Gentleman's recognized for hopefully less than 5 minutes.
Oh, 1 minute. So I just commend both sponsors and also the brevity of Mr. Capuano. I very much appreciated last week our comedy on legislation and look forward to it on future legislation that we have later on today. I'll yield. I can see something's coming here. No? Okay.
Would the gentleman yield?
Yeah, sure.
I'm starting to get nervous.
Taking back my time. No reason to be nervous. Everything is good. As Mr. Stivers said, and you would have said, it really, if you like what was in the original legislation, this simply brings it back to its original intent, and what can be wrong with that? So I yield back and commend both gentlemen for working it through, and just as the chairman said at the very beginning, adds up another check as far as the number of bipartisan bills that comes out of this committee. So thank you, Mr. Chairman.
Gentleman yields back. Who seeks recognition? For what purpose does the gentlelady from New York seek recognition? Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member. I support this bill, and I want to thank my friend from Massachusetts, Mr. Capuano, as well as Mr. Stivers for their hard work. This bill would make a very simple technical fix to the Volcker rule that would avoid the need for large numbers of funds to change their names for no absolute good reason. The Volcker rule prohibits banks from owning hedge funds or private equity funds, and I believe this is critically important because it prevents banks from taking on the risks that comes with hedge funds and private equity funds, which are not appropriate for banks. However, the Volcker rule does allow banks, under limited circumstances, to organize and offer hedge funds and private equity funds. In other words, the bank can help get the fund started, but once the fund is up and running, the bank can't have a significant ownership stake in the fund. One condition of this exception for getting a fund started is that the bank and the fund can't share the same name or a variation of the same name. The intent of this name-sharing ban was to ensure that banks don't feel obligated for reputational reasons to bail out a fund that it initially organized. However, due to a quirk in the way the Volcker rule was drafted, this name-sharing ban applies not just to the bank's name, but also to any investment advisor that is affiliated with a bank, even if the investment advisor has a completely different name than the bank. It is not clear to me how this furthers the original goal of deterring banks from bailing out funds that they organized. The fund would still have a completely different name than the bank. In fact, the fund would not share a name with any taxpayer-backed company. It is difficult to see how this could lead to an expectation that the taxpayer-backed bank, which didn't even organize the fund, would bail the fund out. So I think that this fix makes sense. Any benefits we get from applying the name-sharing ban this broadly, and the benefits are very remote, are far outweighed by the cost or renaming large swaths of funds, which could lead to significant investor confusion. So I urge my colleagues to support this bill, and I yield back.
Gentlelady yields back. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. The bill is ordered reported to the House with a favorable recommendation. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. Now, pursuant to notice, I call up H.R. 4139. The clerk will report the bill, which was distributed in advance.
H.R. 4139, to amend the Sarbanes-Oxley Act of 2002 to provide a temporary...
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentlelady from Arizona, Ms. Sinema, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chair and members. I'm really grateful to all the folks who have already supported this bill and would urge my colleagues to support the legislation. This is a bipartisan piece of legislation that makes it easier for startup companies to get access to the funds that they need without having to face additional burdens and hurdles as they are working in the early years of their startups. Mr. Chairman, I yield back.
Gentlelady yields back. For what purpose the gentleman from Pennsylvania seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
I also thank the chairman for scheduling this bill today. It's called the Fostering Innovation Act, H.R. 4139. As we just heard, it's a bipartisan solution. It's going to help provide some of our most innovative startup businesses with temporary regulatory relief, while at the same time providing investors with the necessary protections and the peace of mind that they're entitled to. Specifically, the solution extends the exemption from Section 404B of Sarbanes-Oxley for emerging growth companies. It's going to provide an additional 5 years of relief, or at the end of the fiscal year in which these firms average gross revenues which exceed $50 million, or when they reach a public float of $700 million with the SEC. Large, established public companies have a different set of financial considerations than smaller startups. And it's burdensome and it's incredibly costly for these small, innovative firms to comply with rules that should not apply to a company of their size, especially if they do not expect to see a profit for nearly a decade. During an earlier hearing with the Capital Markets Subcommittee, a CEO of one of these small businesses spoke about the need for these types of targeted regulatory relief. He was a constituent of mine, and he testified on the cost of regulatory compliance, the negative impact on research, hiring, and potential growth. His particular company had about 50 employees, and he was currently deciding whether or not he could hire an additional researcher or innovator, or whether he was going to hire a compliance official. H.R. 4139 will ensure that he's hiring the researcher so that the therapies come into the market faster and that more American lives will be better off. So I thank my colleague from Arizona, Ms. Sinema, for working to find a bipartisan compromise, and I hope this bill will get to the floor of the House and receive the swift consideration and action that all jobs bills should. I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition?
Mr. Chairman and members,
Move to strike the last word.
move to strike the last word.
Gentlelady is recognized for 5 minutes.
And I've taken a very careful look at this legislation, and I know what my colleagues are attempting to do. However, I have concerns. Mr. Chairman, this bill would amend Sarbanes-Oxley to exempt emerging growth companies for up to a decade from Section 404B audit if they meet certain revenue and public float requirements. The Dodd-Frank Act already exempts 60% of issuers from having an auditor review their internal controls over financial reporting. And unfortunately, that exemption has likely resulted in less investment for those smaller companies and at greater cost. In a 2013 study, the GAO found a greater percentage of companies not required to comply with the Section 404B audit restated their financials more than did those required to comply. And to be clear, restatements are devastating to a public company's reputation. Mr. Chairman, did you know that 72% of institutional investors in a 2015 study rely on the Section 404 audits when making investment decisions? These are financially sophisticated investors. If this committee really wants to encourage more liquidity in smaller public companies, we should first start by figuring out ways to attract investors, not push them away. I'd also like to point out that the bill has the potential to hurt the very companies it seeks to protect. Joseph Carcello, a CPA and member of the SEC's Investor Advisory Committee, testified that auditors, rather than management, detect approximately 75% of the internal control deficiencies in these small companies. He also informed us that management tends to downplay internal control deficiencies as less severe, and auditors must frequently override these classifications. Both the company and the investor lose the longer financial wound is allowed to fester. Auditor reporting on public companies provides substantial benefits to investors and to the companies. It promotes strong internal controls, fosters investor confidence, and prevents fraud. In the biotech industry, which this bill purports to assist, only 1 in 10 drugs that start the first of 3 phases of clinical trials required by the FDA complete all 3 stages and are approved. This means that 90% of drugs created by these biotech companies fail, and the money invested by the public in these companies to create a successful product is gone. This industry is extremely high risk. Investors need to be confident in the financial reporting of these companies. If a biotech company wants to access the U.S. public markets where everyday Americans invest their hard-earned savings, it should comply with the 404 audit. Investors should not have to trust a company's manager to hopefully get it right, especially not for 10 years. Vermont Law School securities professor Jennifer Taub, in testimony included in the public record, wrote, and I quote, "The Fostering Innovation Act is misnamed. Unless the innovation to be fostered is creative accounting schemes leading to restatements and investor losses." I agree. I have serious concerns with this bill that allows companies to have weak internal controls and makes it harder for investors to gain access to information they rely on in determining the value of their company. When it comes to financial reporting, we should all invoke a Republican hero, Ronald Reagan, trust but verify. I don't know why my colleagues in this case, I don't know about my colleagues, but I want to empower the millions of Americans saving for retirement and the pension plans in which they invest with confidence that they can rely upon the reported finances of U.S. public companies. So I cannot support the bill, and I would caution my colleagues that oppose audits and remind them the reason for audits is to make sure that the risk that may be involved is corrected and it is not borne by the investors. So I would yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from New Jersey seek recognition?
Strike the word for a minute or so.
The gentleman is recognized for 5 minutes.
So we live in interesting times when the ranking member is quoting Ronald Reagan. Ronald Reagan also said, "Tear down that wall." And I think that's what we've been doing in a bipartisan manner for a long time, tearing down that wall that was erected over the last several years through Dodd-Frank and the rest that is blocking the commerce from both sides to get through. It was a few years back that everybody talked about the now infamous bridge to nowhere. And if I can make the analogy work here to the on-ramp situation, as I look around right now, I don't think there's a member on this side of the aisle, actually, that was here when SOX passed, was made into law, Sarbanes-Oxley. I guess there are a few people from the other side that were here, but we weren't here when this passed. But when we got here, a number of us worked to try to fix SOX. As a matter of fact, I worked with the gentlelady from New York, and that's referenced as far as the beginning phase of it, so I thank her for doing that together. This is just the next step. So we then moved on to the Jobs Act 1.0, completely bipartisan, the President signed it into law, to do what? As I always say, create an on-ramp for these smaller companies. Then we knew that someday we would get to the next phase, which we're sort of doing later on, which is Jobs 2.0, to the main ramp and the main road, and then exit, because that's the whole reason investors go into something, is to look down the road when they can get off. So my analogy to the bridge to nowhere, and this is where I'll close, is this. It does you no good if you have an on-ramp that is about 10 feet short of where you want to get to, the main road. And that's basically what you have with the 5-year limit in the Jobs Act. You got the on-ramp for these companies, you give them the encouragement to start off, and they do, but especially the biotech companies and the rest find that they get almost up to the top of the on-ramp, getting to go, but they're just not there yet. They don't have the revenue stream. And all we're doing, and that's why I support the bipartisanship of this bill, is to extend it a little bit longer so they can become self-sufficient at that point and continue on their way. With that, I yield back.
For what purpose does gentlelady from New York seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member. I think this bill is a sensible compromise that provides narrowly targeted relief to only the companies that truly need it. I'd like to thank my colleague, Ms. Sinema, for working so hard on this bill and for putting together a thoughtful compromise. I opposed a previous version of this bill in the last Congress because I thought it was far too broad. It would have exempted thousands of companies from the auditor attestation requirement in the Sarbanes-Oxley Act. This requirement, known as the 404B requirement, has been proven to be effective. A 2013 GAO report found that the 404B requirement generally has a positive impact on investor confidence in the quality of financial reports. But we also have to acknowledge that this requirement, while useful, is also undeniably very expensive and might not be necessary for a small subset of companies whose business model is extremely unique. Biotech companies in particular raise money from investors and then initially funnel most of that money into research and development. Researching a new drug and obtaining FDA approval is a very, very long and expensive process. As a result, some biotech companies don't even start producing revenues, or certainly significant revenues, for many years, much, much longer than most companies. This bill would provide targeted relief for only those type of companies. And companies that have a large market cap but still do not have sufficient revenue to pay for compliance with the 404B requirement. The bill is very narrow because it provides temporary relief to companies that are exiting their 5-year period as an emerging growth company and still have annual revenues of under $50 million. This revenue ceiling is extremely important. It essentially makes companies prove that they can't afford the 404B requirement. Once a company's revenues exceed $50 million, then they lose the relief because at that point they can afford to pay for the 404B compliance. And the most relief that companies could get under this bill is 5 additional years after the emerging growth company period ends. So I think this is a very good compromise. It successfully limits the relief to only the companies that need it because of their unique business models and the lengthy process of FDA approval. And I just want to make it clear that this bill does not under any circumstances provide any companies with an exemption from the requirement to file audited financial statements. That is still a requirement, and under no circumstances does the bill allow a company to evade this critical investor protection. So I urge my colleagues to support this narrow application and this thoughtful compromise that has been put forward in a bipartisan way. And I yield back.
Gentlelady yields back. For what purposes gentleman from Arkansas seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to add my support to the work of Ms. Sinema and Congressman Fitzpatrick on this bill. For several years, I was involved in a small cap company that was public in the years after Sarbanes-Oxley and went through the preparation process for compliance with 404B. And this was a company that maybe had $6 million in EBITDA and a $70 million or so market cap. And the expenses that are outlined in the materials related to this bill of approximately $1 million are not far off. And so you take $1 million from that $6 million, and you can see the impact on small companies of the tremendous micromanagement detail required under 404B's internal control auditing. It's just really substantially a burden on small, low revenue or emerging companies. So I think that this proposal does make common sense and is removing a major barrier to our small industries that want to have an opportunity in the public markets and look at an alternative to private capital growth. And like the gentlewoman from New York said, this does not remove their requirement to have GAAP-reported auditing financial statements. It doesn't remove their obligations they have under their officer and director liability insurance coverage. It doesn't in any way change the obligation of management and the board to having internal controls that meet GAAP standards. It just simply says you don't have to go through the 404B extra documentation and extra external certification of that documentation, which is the costly part. So I commend the authors of this legislation, and I yield the balance of my time, Mr. Chairman, with your
Will the
permission.
gentleman yield?
Yes, I will yield to the ranking member.
The company that you just described would be exempt under Dodd-Frank.
No, I understand that, but I just used it as an example of my personal experience of the costs associated with 404B, not to get involved with the details about what its market cap was or the income.
Yeah, it would be exempt, less than 75 million in public float.
Well, it had
60% of all of the companies, so you would fit for that exemption.
Well, the market performance of that company, sometimes it was worth $50 million and sometimes it was worth $150 million. So market caps vary dramatically in small cap stocks. And so my point stands, while I respect the ranking member, that it's the cost pursuant to the low income and emerging nature of businesses of this size range. So again, I commend the legislation, and with the chairman's permission, would yield the balance of my time to Mr. Fitzpatrick.
The gentleman from Pennsylvania is not seeking time. Would you yield to the chair?
I would yield to the chair.
I thank the gentleman for yielding. Again, as we all know, this is an economy that is limping along at about 2% economic growth. We know that working families, the median income is down since over the last 8 years. Family net wealth is down. This is an economy, again, that is limping along at perhaps half of its historic economic growth, a little bit more than half. And if there's any place to err, it ought to be on the err on the side of promoting economic growth. Entrepreneurship, small business formation is at a generational low. And so we ought to err on the side of helping working Americans and those who aren't employed full-time, who want to be employed full-time. The ranking member brought up that some companies might be hurt if they don't comply with Sarbanes-Oxley. Well, let's give them the choice. If the market demands, if investors demand, certain companies will voluntarily comply. In fact, I think just about everything in the Jobs Act is voluntary. But if there's one area of bipartisan legislation that has been helpful to our economy, it has clearly been the series of Jobs Act, most of which have come out of our capital markets subcommittee. Again, as has been pointed out by numerous members, these companies will still have to file audited financials. We're simply talking about mandatory 404B under Sarbanes-Oxley for these early growth startups that are so critical to the economy. So I want to thank the gentlelady from Arizona, thank the gentleman from Pennsylvania for their bipartisan work. I think it's an important act I would urge all members to adopt. Time of the gentleman has expired. Who seeks recognition? The gentlelady from Arizona seeks recognition. She has previously been recognized. I was asked unanimous consent that she be able to speak again without objection. Gentlelady from Arizona is recognized.
Thank you, Mr. Chair. I want to point out a couple things about this legislation that I think are important. I appreciate other members who've mentioned some of these facts as well. And again, my thanks to Mr. Fitzpatrick for his co-sponsorship of this bipartisan bill. This exemption already exists in law. And so passing the legislation to extend it for a period of 5 years simply gives the businesses that are doing this research and development work, that are bringing drugs to market, that are doing this bioresearch, a longer ramp time to invest those dollars into the important research and not have to spend upwards of $1 million per year on an outside audit. Most of these companies that are impacted by this very targeted exemption, it's a very small number of companies who function under a research-driven business model, they don't have the liquidity to do $1 million a year of an outside audit. And, Mr. Chair and members, these firms are already required, their management already has to assess internal financial reporting controls. So it's not like they're operating without any kind of financial accountability. They are following all of the additional rules under the law, and they are assessing internal financial reporting controls. This is simply continuation of an already existing statute that gives slight relief to the very costly burden for these companies in their early years. And again, Mr. Chair and members, if we were to cut off this exemption and not extend it for additional 5 years, many of these businesses would have to change their financial model to take money out of doing the research and bringing those important products to market, and instead comply with an outside auditing requirement that doesn't provide additional security or support beyond which they are already required to do under other portions of the law. So thank you again, Mr. Chair. Thank you, Mr. Fitzpatrick, and members who are supporting this legislation. I yield back.
Gentlelady yields back, who seeks recognition. There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye.
To submit to the record. Oh, I'm sorry.
I'm sorry.
Unanimous consent to submit to the record two communications, Americans for Financial Reform and Public Citizen.
It's covered under general leave. Again, there being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4166. The clerk will report the bill which was distributed in advance.
H.R. 4166 to amend the Securities Exchange Act of 1934 to provide specific credit.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Kentucky, Mr. Barr, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chairman. I would like to first start by thanking my friend and colleague, Congressman David Scott from Georgia, for working with me on this bipartisan pro-growth legislation. H.R. 4166, the Expanding Proven Financing for American Employers Act, is a win-win-win. It solves a problem created by a federal rulemaking, it enhances consumer protections, and it ensures the availability of a sound source of financing for American businesses that would allow them to grow and hire more workers. What we're talking about here is preserving the market for collateralized loan obligations, or CLOs, a type of investment fund that bundles collateral-backed business loans, typically senior secured industrial commercial loans for purchase by investors. Dynamic job-producing companies across America, such as Dunkin' Donuts, Chrysler, Delta Airlines, and Tempur Sealy and Novellus, with presences in my district, use CLOs to fund expansion and job creation. Over 1,200 companies employing more than 6 million people utilize CLO financing. And in the past 20 years, CLOs have had a default rate of less than 0.5%, and not a single tranche of AA or AAA loans has ever failed, even during the financial crisis. And yet, CLOs have been inadvertently impacted by the multi-agency risk retention rule, which was finalized in October of 2014. This rulemaking, required by Section 941 of the Dodd-Frank Act, mandates regulation of asset-backed securities. Section 941 was a response to the collapse of the mortgage-backed securities market during the financial crisis and sets out the credit risk retention requirements for securitizers and originators. Requiring managers to retain some skin in the game may be a sound policy, generally speaking, But Section 941 and the risk retention regulation promulgated pursuant to that section of the law does not account for the unique structures of CLOs, and it will dramatically increase compliance costs of new issuances by imposing excessive risk retention requirements on CLO managers that are neither securitizers nor originators. The result, we fear, will be that the regulation will substantially disrupt the CLO market, and in fact, it already has. The second half of 2015 saw a 37% decline in issuances compared to the first half of that year. 30 CLO managers that issued CLOs in 2014 did not issue in 2015, and as predicted, it was the smaller players that were pushed out of the market. Moody's and Fitch predict that CLO formation will continue shrinking through 2020 when a refinancing wall may force bankruptcies and market turmoil if no new CLOs are available as a result of this regulation. Our bill would prevent that kind of disruption, and in this way, our legislation enhances financial stability by ensuring the availability of funding for companies facing this maturity wall. So here's an explanation of what the bill actually does. The bill addresses the regulatory shortcomings by defining a qualified CLO that would be considered as satisfying the requirements of the risk retention regulation. This concept actually meets the policy objectives under Dodd-Frank of containing risk, aligning with international standards, and it would not compel regulators to revisit or expand the definition of credit risk. The new structure will allay concerns about risk contagion in the marketplace while providing companies, investors, and managers the certainty they need to continue to provide and benefit from this important source of financing. The idea here is to offer regulatory relief to qualified CLOs, much like the qualified mortgage rule offers protection from liability for certain high-quality mortgages. This makes sense since CLOs represent an asset class that performed much better than the mortgage-backed securities that were at the epicenter of the crisis. So if the concept is good enough for mortgages, which were actually at the core of the crisis, it certainly should be good enough for CLOs, which performed much, much better during the crisis. The qualified CLO definition would achieve these policy goals in the following ways. Number one, ensuring that the assets are high-quality, non-investment grade loans, ensuring that the asset portfolios are sufficiently diverse, requiring leverage limitations, interest coverage and over-collateralization tests to provide additional protections for investors, requiring the manager to retain 5% of the CLO's equity, again satisfying the Dodd-Frank requirement of risk retention, requiring transparency and disclosure through monthly reports on asset portfolio performance, and maintaining regulatory oversight by requiring that the CLO manager be a registered investment advisor. So I encourage my colleagues to support this bipartisan Expanding Proven Financing for American Employers Act to both protect investors and ensure a future for funding vehicle that fuels growth and job creation. Yield back.
Mr. Chairman.
Gentleman yields back. For what purposes gentleman from Georgia seek recognition?
Strike the last word,
Gentleman is
Mr. Chairman.
recognized for 5 minutes.
Mr. Chairman, I fully support H.R. 4166, which was introduced by myself and my colleague, Representative Barr. This makes perfect sense, and especially at this time, we've got to do everything we can do to make sure that our business sector, our economy, is the foremost economy on the world stage. This does that. The most important reason why I support this measure is because I believe, and I think the majority of this committee believes, that it is incredibly important that we continue to make sure that American businesses have access to a variety of financing options. And CLOs provide that critical financing options. First of all, CLOs are strong investment tools that allow U.S. non-investment grade companies to finance and grow their businesses. Mr. Chairman, 1,210 companies, businesses throughout the United States, many of them including like Delta Airlines, for example, the world's #1 largest airline, which is located, of course, in my district. They have used CLOs as a very, very important financial tool, along with others, small, medium, and large. Now, Without the CLOs, it would be incredibly difficult for our businesses to find finance options for their businesses. Now, I might add that Chair Lady Ellen was before this committee last week. We asked her about those issues, and in a letter responding, she said regarding qualified CLOs, she noted that an increase in the availability of CLOs that reflect strengthened underwriting and compensation standards, among other features, could be considered a very positive development in the market. Now, H.R. 4166 does precisely that. It reduces the retention requirement to 5% of the equity of the CLO rather than the fair value, so long as the CLO is qualified. And our CLOs are qualified CLOs or QCLOs. And in order to qualify as a qualified CLO, which meets the recommendations that Chair Lady Yellen mentioned, they must adhere to a series of best practices across 6 different categories. 1, quality of assets. 2, portfolio diversification. 3, minimum capital structure requirements. 4, alignment of interests. 5, reporting and disclosure. And 6, manager regulation. That puts a very secure package together and certainly meets Chair Lady Yellen's concerns as she expressed. Adherence to these best practices ensures that when these companies refinance, they are able to do so smoothly without the difficulty. And that's very important. We compete around the world. And many areas, our business sectors are sliding backward. We don't need that. We need to keep Americans' business at the front, number 1, as the most significant businesses in the world. This does it. I want to thank Representative Barr for all his hard work in drafting HR, and I encourage a yes vote. Thank you, Mr. Chairman.
Gentleman yields back. For what purposes? Gentleman from Maine seek recognition.
Strike the last word, please,
Gentleman
Mr.
is
Chair.
recognized for 5 minutes.
Thank you, sir. Appreciate it very much. I first of all would like to commend Representative Barr from Kentucky and excuse me, and Representative Mr. Scott from Georgia for doing great work on this bill. You know, there are so many regulations and the president's really smothering financial regulations that need to be adjusted. And here's a common sense way to do it. In particular, I'm very concerned, I know many are, Mr. Chairman, on this committee, about how our business is being stifled by these regulations in one particular way, in that credit is becoming less and less available, more and more difficult, such that our companies are having problems to grow and hire more workers. Now, everybody who's run a business before knows, in fact, that you need money to grow, to expand your operation, to hire more people, to pay them more, to offer new products and services. And sometimes these businesses are able to borrow from traditional banks. Now, sometimes they cannot. And when they cannot, it is very important for us to make sure that they have the ability to sell bonds to investors around the world by way of our capital markets. That's a terrific way to borrow for those who are unable or choose not to from other more traditional sources. Now, this bill, H.R. 4166, is well named Expanding Proven Financing for American Employers Act. It's a terrific name, Mr. Barr, and I salute you for naming it such. Now, as we've mentioned here in this discussion already, Mr. Chair, CLOs are a proven way to raise money for businesses who ordinarily might not have an opportunity to grow. Now, the regulations make it very clear that these organizations that manage these CLOs have to make sure they have skin in the game. And that's important because if something goes wrong, even with its proven record, you need to make sure that everyone's held to account. However, going way beyond what is necessary required by the law will actually stifle and contract credit that we're trying to extend to these businesses around the world. And Mr. Scott, you just mentioned a minute ago, and so did Mr. Barr, that there's about $400 billion of CLOs in this market right now that's been extended to about 1,200 companies that employ in aggregate 6 million American workers. So it is up to us, Mr. Chair, to do everything we can to make sure we help people in this country have good-paying jobs with better lives, better futures, more independence, and better opportunities. And as a result, I think that this fix, H.R. 4166, this fix to the present smothering financial regulations is a very good idea. I encourage all of my members, Republicans and Democrats on this committee, to please support 4166. Thank you, Mr. Chair. I yield back my time.
Would you yield to the chairman?
Yes, I would, sir.
I thank the gentleman for yielding, and I simply want to amplify the gentleman's comments. First, I want to thank the gentleman from Kentucky and the gentleman from Georgia, Mr. Scott. This is yet another bipartisan bill that is being presented in this markup. I listened very carefully to the gentleman from Kentucky. I think I have this right, that the 10-year cumulative impairment rate on CLOs is a tad over 1%. Is that correct? And the gentleman is nodding in the affirmative. And so 10 years would include the financial crisis. So a key component of corporate financing of almost $500 billion in our economy provided by CLOs. Regrettably, it has an acronym that is somewhat close to CDOs, and I understand their impairment rate was almost 50%, but one has to be distinguished from the other. One, again, including the financial crisis, has roughly a 1%, a hair over 1% default rate, and yet, as the gentleman from Maine pointed out, we have millions of people today who are working for companies that CLOs remain a vital part of their finance mix. And why do we want to harm it? Again, what we're seeing is an economy producing just a little bit over half of its historic economic growth. That hurts working families. It means they can't send kids to college. It means maybe they can't replace a clunker of an automobile. It means that they can't put down the down payment for their part of the American dream to perhaps buy a new home. So I want to commend the gentleman from Kentucky, commend the gentleman from Georgia. This is a common sense, a very common sense narrowing of this particular risk retention rule. I urge all members to adopt it. The time of the gentleman has expired. Who seeks recognition? For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
I'm baffled by legislation such as this. As everyone on this committee should remember, the 2008 crisis was caused in large part by mortgage companies that originated loans to borrowers that had no ability to repay, while the mortgage companies and the firms that securitized these loans into complex packages charged high upfront fees and made off with lots of profits. Investors in the securities entities, like pension funds such as CalPERS, were left holding the bag. To address this problematic originate-to-distribute model, Dodd-Frank included an important component known as risk retention, or simply skin in the game. In essence, Congress told loan originators and securitizers to eat their own cooking before selling off the investments to others. And while 2008 crisis related to residential mortgages, Dodd-Frank endeavored to do more than narrowly address just the last crisis. The law said that we also needed to prevent other systemic risk from harming our economy and therefore required risk retention for other classes of assets. This bill, H.R. 4166, takes us in the wrong direction, essentially exempting most securitizations of corporate loans from risk retention. This bill would vastly diminish the instances where securitizers would have to have skin in the game, and thus would diminish the underwriting standards that we sought to promote in the Dodd-Frank Act. H.R. 4166 relates specifically to collateralized loan obligations, or CLOs, which are securitizations of corporate loans, typically loans to riskier companies. CLOs are often used to finance private equity takeovers of companies through leveraged buyouts. The industry advocated for the exemption contemplated in this bill when they wrote letters to the regulators during the comment period. Regulators heard their arguments and rejected their proposal. In fact, regulators pointed out that the leveraged loan market may be getting overheated and that, quote, characteristics of the leveraged loan market pose potential systemic risks similar to those observed in the residential mortgage, quote, unquote. They also noted that the, quote, again, leveraged loan market creates an environment susceptible to some of the abuses and excesses that contributed to the financial crisis, quote, unquote. Mr. Chairman, when our banking regulators tell us that there may be a bubble, I think we ought to listen. And after receiving over 10,500 letters on their proposal, regulators declined to offer the exemption contemplated in this bill because they thought it was risky and inappropriate. Finally, let me note that this bill is based on the presumption that the CLO market is not functioning properly and that it needs regulatory relief in order to be healthy moving forward. In fact, many regulators actually fear that the CLO market is too frothy, with 2015 being the second highest year in history in terms of CLO issuance, behind only 2014 in terms of volume. Moreover, according to analysts at Moody's, most new CLO managers will be able to comply with the risk retention rules moving forward. In sum, this bill is overbroad, ill-conceived, and could open our financial system up to inappropriate risk. I don't know why we want to go back down this road again. I would think that people would be moving with a lot of caution and understanding how important it is to have risk in the game. And to move in this direction really tells me that there must be some amnesia about what we went through. I will thank you very much, Mr. Chairman, and yield back the balance of my time.
For our purpose, the gentleman from Ohio seek recognition.
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank the gentleman from Kentucky, Mr. Barr, the gentleman from Georgia, Mr. Scott, for their leadership on this issue. As the co-chair of the Middle Market Caucus, middle market companies rely on collateralized loan obligations as a source of funding very frequently. Middle market companies are companies you haven't always heard of, but they're companies that are driving our economy every day. The average middle market company had revenue growth as of the end of last year, year over year, of 6%, employment growth at 4%. They're driving the economy at a time when we need that. Meanwhile, credit has tightened, and many of these companies are seeing their ability to finance that job growth constricted by banks and their rules and the Federal Reserve, as well as rules that the CLO market is now under that is tightening the CLO market. These companies, some of you might recognize some of the names, like Wendy's International, a delicious food company based in my district that makes fabulous hamburgers, cheeseburgers, and chicken nuggets. But and my kids keep them in business, as do my wife and I. They have $246 million of collateralized loan obligations. Without that, they could not make the delicious cheeseburgers you rely on every day. So they're just an example. In the ranking members district, there's companies like DaVita and Pelican, which are Pelican Products, a general manufacturing company, that rely on these financing sources. These financing sources are important. They're important to our overall economy and economic growth and jobs, but they're also important to these companies to be able to serve their customers. As we see a tightening and constricting 2 quarters in a row by banks and other finance companies, we need alternative opportunities to get capital like collateralized loan obligations. That's why this bill is so important. It's great that it's bipartisan, but it really will ensure that there's skin in the game, that there are rules around these collateralized mortgage obligations to see what's qualified, much like we do a qualified mortgage. So maybe we should be talking about getting rid of qualified mortgages too, if people are concerned about qualified collateralized loan obligations. But it will make sure that we have a fixed income market that works and gets capital to the companies that need it, that are driving our employment, and a lot of companies that you and I have never heard of because they're middle market companies, but it's an important source of financing, and the CLO market needs to have a rational and reasonable approach. This approach that the two gentlemen have worked on so hard makes sense, and it will look out for economic growth and our job market, and will move us all forward. And I think the gentleman's trying to get me to yield him some time. I will yield the balance of my time to the gentleman from Kentucky.
Well, thank you. Thank you, Congressman Stivers, and appreciate your recognition of the importance of this source of funding. If I could, in the remainder of your time, just address a couple of the points, the arguments made by the ranking member, and I would just note for the ranking member that while she is citing an originate-to-distribute model that perhaps was at the epicenter of the financial crisis, CLOs don't use that model. They don't use the originate-to-distribute securitization model used in mortgage-backed securities. Rather, CLOs are long-only funds that operate more like mutual funds. The manager of the CLO uses the proceeds received from note holders to acquire corporate loans at their discretion in the open market, and then actively manages this loan portfolio on behalf of investors. And since the manager's remuneration is contingent on the CLO's positive performance, the CLO's manager's interests are highly aligned with the CLO investors. That's fundamentally different than what we saw in the run-up to the crisis with the originate-to-distribute model with mortgage-backed securities. She also suggested that leveraged loan market is overheating. Well, that's certainly not the case with CLOs when you look at the fact that in 2015 you had a 37% decline in CLO issuances. And then finally, she cites Moody's. Well, here's what Moody's says about the CLO market. Rising defaults and the impact of the Dodd-Frank Act's risk retention rule will make it more difficult for existing CLOs to supply corporate financing. And so I would just note those points in response to the ranking member's arguments. And remember, CLOs have a proven record of performance, low default rates, even during the financial crisis. And I think you've got to recognize the difference in the way CLOs have performed because of their unique features, the alignment of interest between the managers and the investors, the transparency, the diversification in these portfolios, and other features. And I yield back, and I thank the gentleman.
Time of the gentleman has expired. Who seeks recognition? For what purpose does the gentleman from California seek recognition?
Just strike the requisite number of words.
Gentleman is recognized for 5 minutes.
Okay. I'd like to address both 4166 and 4620, which I know will come up later, and the entire focus on collateralized debt. The chairman is right that when credit is too tight, jobs are not created. The ranking member is right to point to the risks when credit is too loose, when you can unravel the financial system, as happened in 2008. And if we could have a system where we have an idiosyncratic and ineffective credit restrictions, then we could have the worst of both worlds. That is to say, we could have substantial investor risk and systemic risk, while at the same time cutting off capital to worthy projects and worthy business expansions. And of course, it is the worst of both worlds that we get to some degree with the present system. We have risk retention in Dodd-Frank. What we don't have is a change to the credit rating agency system. And it is the credit rating agencies that caused the last crisis, and it is the credit rating agencies that will cause the next crisis. And I'm not sure that risk retention will protect us from the next crisis. The credit rating agencies are selected and paid by the issuer. Last time they gave AAA to Alt-A. Last time the problem was residential mortgages. Next time, it will be some other kind of debt. But debt is critical to our financial system. It is far more important than the stock market when it comes to financing economic activity. And as we saw in 2008, when people who have taken what they thought were moderate risks instead face the risk of massive defaults, our entire system can implode. The present system, I say, doesn't deal with that. Franken and Sherman had an amendment in Dodd-Frank designed to deal with credit rating agencies. It was halfway watered down in the conference committee and then basically obliterated by the SEC. So we're stuck instead with risk retention as some system to try to prevent bad debt. But this system is idiosyncratic. As I understand it, if you just issue an unsecured bond, there's no risk retention. If you have a mutual fund that invests in junk bonds, there's no risk retention. The risk retention comes when you have a package of securitized debt, whether it's secured by commercial mortgages or otherwise. So I don't know how I'm going to vote on either of these two bills. They offer a risk retention system for a small portion of the debt being sold to investors. And so then that's what Dodd-Frank provides, and then these bills slightly change the risk retention system. What we need instead is to make sure that all the major debt issuances are subject to a credit rating from a rating agency that is independent, not one that is selected and paid by one of the teams. If you're trying to organize a baseball league, you need to make sure that the umpires are not selected and paid by the home team. And any amount of risk retention is not going to allow that league to function if indeed the umpire continues to be selected and paid by the issuer. So these bills might slightly change and beneficially change or perhaps make slightly less helpful the risk retention system found applicable to only some debt issuances under Dodd-Frank. I don't know how I'm going to vote on the bill. I do know that our system will not work effectively until we have honest ratings of major debt issuances by credit rating agencies that are selected by the SEC so that giving a good grade will not lead to highly profitable additional engagements, and I yield back.
Time of the gentleman has expired. For what purposes? Gentleman from Michigan seek recognition.
I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chair, and I don't intend to use the full 5 minutes here, but I do want to just encourage and back up my colleagues, both from Georgia and from Kentucky on this. And as Chair of Monetary Policy and Trade and deal with the Fed on a daily basis, congratulations, getting about as clear a endorsement from the Fed as the Fed will possibly issue, which is not very clear, I might add. But they are saying kind things, they are saying nice things, because they realize, and that, and in the response from Chair Yellen, the board, this is a quote, the board recognizes that certain structural features of the qualified CLOs may contribute in some degree to aligning the interests of CLO managers with investors with respect to the quality of securitized loans. In this regard, an increase in the availability of CLOs that reflect strengthened underwriting and compensation standards, among other features, could be considered a positive development in the market. And I agree with Chair Yellen on that. I, unlike my colleague from California, do know how I'm going to vote on this because I do believe that this is an improvement, and I believe that we are headed in the correct direction here. And I think has been noted. We're going to be seeing significant amounts of money and debt that is going to be that's going to be coming due through 2020 and the next 4 years. This debt is going to be needs to be refinanced, or these companies are going to be facing some significant credit crunches, which is why I believe that H.R. 4166 is necessary to distinguish these CLOs from other asset classes as they are moving forward. And as has been noted, the household names that we're all familiar with utilize this, as do those companies that are under the radar that we might not know unless they are particularly in our district. But I just wanted to take this moment to say congratulations on the bipartisan work that was put forward. Getting the Federal Reserve to look favorably upon this is, I believe, an accomplishment. And folks, we're doing our job. We are working on a bipartisan basis to try to make it a better environment for our companies here in the United States to be able to go compete, to succeed. And as we've seen, so many barriers that have been put up, intentional or unintentional, it's time that we make it easier to do business here in the United States. And I'm happy to support this bill. So with that, I yield back.
Gentleman yields back. For what purpose does the gentleman from Illinois seek recognition?
Mr. Chairman, I have an amendment at the desk until...
We will pause while the amendment is distributed.
Amendment enumerated Foster 53. There's a pair of amendments.
Have all members received a copy of the amendment? If so, the clerk will report the amendment.
Amendment offered by Mr. Foster, page 2, beginning on line.
Without objection, the reading of the amendment is dispensed with. The gentleman is recognized for 5 minutes on his amendment.
Thank you, Mr. Chairman. I served on this committee both during the financial collapse and the emergency regulatory response to make sure that that sort of calamity never happens again. During that time, we spent a lot of time trying to separate the parts of our financial system which had been irretrievably broken from those that in fact survived the financial crisis. And CLOs were one class of assets that in fact did survive with the low losses that have been discussed already. So because of that, I think that the spirit behind this bill to establish reduced risk retention for CLOs that meet slightly expanded requirements, I think is a very reasonable improvement of the Dodd-Frank Act. So that my amendment actually does three things. First, it would require a 100% rather than a 90% of the assets in a qualified CLO be loans and cash equivalents. This means that all of those assets, the reduced risk retention will be available for CLO funds that are making capital investments available to companies that will create jobs in our communities, which is the point of this bill, rather than investments in high-yield bonds or other more speculative investments. It would be 100% focused on either working cash reserves or qualified CLO loans. The second aspect of this amendment is that it addresses the concern that what's called tranche warfare sometimes results when investors are subordinated to others, and it does this by requiring that the fund manager puts some money into each of the tranches. And so that from the point of view of eating what you cook, you have to have at least a small bite of every tranche that you cook. And this is accomplished by requiring 30% of the capital to be in the upper tranches and roughly 70% to be in the equity. And then finally, my amendment ensures that covenants requiring the disclosure of financials be part of every loan incorporated into a QCLO. This is often typically done in the market, but not all the time. And so these covenants are occasionally omitted from covenant-light loans. for example. And so what my amendment simply requires that there be annual audited financial reports available within 90 days of the end of the fiscal year, and quarterly, not necessarily audited financial statements within 45 days of the end of each quarter. This will allow, this financial data will allow the, from the borrower, will now allow the fund manager to much better decide whether to hold or to sell the asset and make sure that the secondary market for these functions well. I believe that this will ensure the continued availability of credit at reasonable prices to the companies that presently use CLOs, and ensure the interests of the fund managers and investors are well aligned. And so with that, I ask my colleagues to support this amendment.
Would the gentleman yield to the chair? I thank the gentleman for yielding, and after consulting with the prime sponsor of the legislation, prepared to accept the amendment. I'm not sure it's all necessary, but hopefully it will ameliorate some of the concerns that have been articulated by some within this markup. Again, I would urge the adoption of the amendment. I yield back to the gentleman, and does the gentleman yield back his time?
Yes.
The gentleman yields back his time. For who seeks recognition? Gentleman from Kentucky seek recognition.
Thank you, Mr. Chairman. And I just want to thank my colleague from Illinois for his contribution with this amendment. And again, you know, the purpose of the qualified CLO legislation is not just to guarantee ongoing access to affordable financing through this very innovative source of commercial credit, but also to make sure that there's sound underwriting and that there are protections in place. And I think in this regard, Mr. Foster has contributed to that, and we appreciate that. And so I would just, again, reiterate what the chair has said, that we do not have an objection to the gentleman's amendment, and I yield back.
Will the gentleman yield? Will the gentleman?
Yes.
Will the gentleman? Just a point of clarification, I guess, for both of you. I'm trying to understand. I guess I'll ask this of Mr. Foster. Would this amendment, I'm getting confused on percentages. Would it require a retention of 3.5% of the equity? Or would it require, for example, if the equity were 8% of the securitization, that it would require close to half of the equity to be retained, that is to say 3.5% of?
So it does not change the total amount of risk retention. But it specifies that up to 30% of it can be moved out, must be moved out of the equity tranche and distributed uniformly in the senior tranches, so that there would be some risk retention for every tranche.
Okay, thank you.
It's my understanding that this is a standard product that is in the market today, that this is not a new invention here. It is something that you can buy for a subset of CLOs that are available in the market today.
Time still belongs to the gentleman from Kentucky. Gentleman yield back. Gentleman yields back. For what purpose does the ranking member seek recognition?
Move to strike the last word.
Gentleman is recognized for 5 minutes.
Mr. Chairman and members, I appreciate the efforts by the gentleman from Illinois to improve this bill, which again I believe would undermine the risk retention rules we crafted in Dodd-Frank. And while this amendment represents a good faith effort, I continue to believe that even if this amendment is adopted, the underlying bill will still be harmful. The first portion of the amendment attempts to address the tail risk that a large downturn in the performance of the underlying loans may spread risk up through the higher-rated tranches of the collateralized loan obligation, or CLO. Recall that this is what happened in the mortgage market when the downturn became very severe. However, while the amendment tries to ensure that CLO managers have skin in the game for these more remote risks, it does so at the expense of the upfront first loss position taken by the managers. What does this mean in practice? It means that we're weakening risk retention in the riskiest piece of the CLO in order to strengthen it in less risky pieces of the CLO. This amounts to robbing Peter to pay Paul. Second, the amendment increases from 90 to 100% the requirement that the assets in the CLO be secured by collateral. However, in discussing this with regulators, they have noted that many times the collateral is not sufficiently high quality or liquid to warrant it being a substitute for real risk retention. And third, the amendment attempts to increase the transparency surrounding the portion of loans that are covenant light, or loans where the lender has placed fewer conditions on the debt or operations of the borrowing company. I believe that this amendment fails to get to the underlying problem, the surge in loans that have these investor protections stripped away. In fact, in talking about the growth of covenant-light loans, one private equity executive from Apollo Global Management noted, quote, "I do see many signs of the bubble of the future. I agree that short-term we're not likely to see that, but all the danger signs are there of a future crisis," quote unquote. Notably, nothing in this amendment relates to improving the quality of underwriting of the underlying loans, something that regulators have said is currently overheating in the markets. As Americans for Financial Reform said in their statement opposing this legislation, and I'll quote, "So long as the underwriting quality of the actual loans," just 1 second here, contained in the CLO qualifying for this exemption are not tightly controlled, then sponsors could issue very high-risk securities without retaining adequate risk. So while this amendment may marginally improve the underlying bill, H.R. 4166 still represents a dilution of the risk retention we secured in Dodd-Frank. And for those of you who participated in Dodd-Frank, risk retention was an important discussion that we had, and it certainly has been identified as a way by which we should protect getting into the situation that we found ourselves in 2008. I yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? Is there any further debate on the amendment? If not, the question occurs now on the amendment offered by the gentleman from Illinois, Mr. Foster. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. Is there any further discussion? There being no further, I'm sorry, for what purpose does the gentleman from Colorado seek recognition?
Move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank Representative Barr and Representative Scott for focused legislation to be able to address some of the many challenges that we see coming out of Dodd-Frank. Without exception in this committee, we've heard testimony that continues to talk about compliance costs. In fact, over the last 2.5 years, we've seen compliance costs for businesses across this country rise from $1.8 trillion to now $2 trillion in regulatory costs. Concurrent with that, however, in this committee, and I believe on both sides, no one argues for no regulations. But we want to be able to have sensible regulations that are going to be adequate to make sure that we are keeping the economy moving, having opportunities to be able to preserve jobs that we have, and the opportunity, more importantly, to be able to put Americans back to work in this country. Unfortunately, in the 2014 SEC risk retention rule, as it came forward, we've identified that this does dramatically increase compliance costs on new issuances, and that's what this legislation, I think, importantly does address. And the risk retention rule, when it defines a qualified CLO that would be considered as satisfying the requirements that are necessary to be able to create a safe harbor that will prevent liability after origination. This is something that I think businesses across the country actually do on a regular basis. If there is a problem, fix it. If you can't, stop doing it. That's just good common sense to be able to be applying, I think, to the regulatory process as well. I do applaud Mr. Barr and Mr. Scott on their efforts on this. When we look at the actual numbers of 6 million people that have their jobs relying on adequate access to capital, companies Del Monte, Chrysler, United Airlines, not to mention their subsidiary businesses that supply some of these companies as well, and the jobs that those create. This is an important step in addressing some of the challenges that we see from a regulatory environment that is overreached, and a good qualified fix to be able to address that challenge. So, Mr. Chairman, I would like again to thank the sponsors of this legislation for moving to help fix a problem and to be able to ensure that we're preserving and protecting American jobs. And with that, I yield back.
Gentleman yields back. Is there any further discussion? For what purpose does the gentleman from Illinois seek recognition?
Mr. Chairman, I have a second amendment at the desk entitled, it's enumerated Foster 54B.
We will pause and allow the amendment to be distributed.
And Mr. Chairman, I'd also like to ask unanimous consent to correct a small drafting error in the amendment. On line 4 of the amendment, to strike the word number and replace it with the word volume.
I'm sorry, replace it with the word what?
Replace it with the word volume, V-O-L-U-M-E. And if the amendment could be read with...
I'm sorry, one more time. It's a 7-line amendment. Which line?
Line 4.
Okay.
Strike the word number, replace it with word volume.
Volume.
And if the amendment could be read with...
Without objection, the word number on line 4 is struck and replaced with the word volume on line 4. Have all members received a copy of the amendment? The clerk will report the amendment.
Amendment offered by Mr. Foster, page 7, after line 14, insert the following. 3, a single issuer may not issue in any calendar year qualified collateralized loan obligations exceeding 10% of the total volume of collateralized loan obligations issued by all issuers in the previous calendar year.
Gentleman is recognized for 5 minutes on his amendment.
Mr. Chairman, this is a simple amendment to limit the concentration in this industry, which is a concern that I've heard from many of the industry participants, that we are headed toward a situation where the issuance of CLOs may become, and is becoming, more and more dominated by a handful of very large players. And so this simply limits the total amount of qualified CLOs that may be issued by any single issuer to 10% of the market for all CLOs. So, for example, in a year where there would be $500 billion of total issuance, this would allow no player to issue more than $50 billion in collateralized CLOs. So it's a fairly straightforward amendment designed to limit industry concentration, which I think is a risk that a lot of people are worried about. I guess it is sort of self-evident. I don't think it requires a lot more explanation, and I'm happy to yield back my time and answer any questions other members have about it.
The gentleman yields back. The chair recognizes himself to recognize that the gentleman from Illinois will now be batting 500 on his amendments. I do not urge adoption of the amendment from the gentleman from Illinois. I'm seeing it for the first time, but my fear is, and I'd be happy to yield time to the gentleman from Kentucky, the prime sponsor of the bill, but my fear is that this would limit the CLO market at a time when, frankly, it continues to be a vital form of financing for so many companies that employ millions of people. I don't want to do anything that would artificially constrain its size. I fear that the amendment from the gentleman of Illinois would do that. I also point out that, again, retail investors, our mom and pops, are not the ones investing in CLOs. So I understand the gentleman's argument from Illinois, but at a time of tepid economic growth that's harming American families, we ought to be doing something to expand a vital source of financing in our economy, in one that historically has approximately a 1% impairment loss. Historically, this has proven to be one of the more stable investments in our financial system, and I'd be happy to yield to the gentleman from Kentucky.
I thank the chairman, and once again, I do thank my friend and colleague from Illinois for his contribution, and I was happy to accept the gentleman's previous amendment. On this one, I have to respectfully object for similar reasons cited by the chairman. The problem that the gentleman from Illinois is trying to solve is really the problem that the risk retention rule itself creates, which is that the rule is creating this concentration already, and there's no better evidence than the fact that small managers dropped out of the market between 2014 and 2015, and they were less than 25% of the size of 2015's leading CLO managers. In other words, it's the rule itself that is creating the consolidation, and to the extent that the purpose of the amendment is to limit concentration, the best thing we can do is adopt the bill and pass the bill.
Very good.
And I would just also submit that bifurcating the industry would really undermine the intent of the bill, because what we're trying to do is maintain a vibrant liquid CLO market for businesses to expand and hire. And splitting the industry up would actually harm the smaller managers. It would actually exacerbate the problem that we're trying to fix here, since the qualified CLO exemption would be based on outstanding issuances. In other words, there's kind of an unvirtuous cycle that would be created by the gentleman's amendment, in my opinion. As risk retention would continue to bite issuers, the issuance volume will decline. Fewer small managers will receive the exemption, leading to a death spiral where only the larger can compete. And recent estimates are that CLO issuance in 2016 will be as low as $40 billion. That's about a third of the volume in 2014. So you can see that less issuance would continue to grow upon itself if the gentleman's amendment were adopted. So I respectfully object to the amendment, and I would just encourage my colleagues to oppose this particular amendment while agreeing to the gentleman's previous amendment, because again, I think the problem that the gentleman is trying to solve, namely concentration, namely consolidation, that problem is fixed by the underlying bill. And with that, I'd yield back.
Gentleman yields back to the chairman. The chairman,
with that,
I'd be happy to yield some time to the gentleman from Illinois.
Yeah, well, I guess in light of this discussion, I guess a 500 batting average is about as good as one can expect in this committee. And so I will withdraw this amendment.
Gentleman withdraws his amendment. Are there any further amendments? Is there any further discussion? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes, a recorded vote has been requested. All those in favor, a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4498. The clerk will report the bill which was distributed in advance.
H.R. 4498, to clarify the definition of general solicitation under federal securities law.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Virginia, Mr. Hurt, for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I represent a rural congressional district in Virginia, Virginia's 5th district, that stretches from northern Virginia to the North Carolina and Virginia border. As I travel across my district, the number one concern I hear from my constituents is about jobs and the economy. At a time when our economy is struggling, Congress must do everything possible to help small businesses achieve success. These entities are our nation's most dynamic job creators, and their success is essential to our economy. Last month, Charlottesville, Virginia, in the heart of Virginia's 5th District, was recognized as one of the nation's fastest-growing markets for venture capital investment. Over the past 5 years, the amount of capital invested in Charlottesville has grown 157%. This type of investment can have a profound impact on a community, making it more attractive to other startup companies and ultimately producing job growth. It is for these reasons that I ask my colleagues to support H.R. 4498, the Helping Angels Lead Our Startups Act, or the HALOS Act. The HALOS Act will amend the Securities Act to define an angel investor group and it will clarify the definition of a general solicitation so that startup enterprises are able to continue to demo their business at certain events where there is no direct investment offering. The HALOS Act is a logical outgrowth of the Bipartisan Jobs Act that we've recently enacted into law. The HALOS Act would alleviate the burden placed on startups with regard to privacy and compliance concerns, which often require entrepreneurs and startups to take on burdens that they do not have the means to handle. These burdens have a significant impact on an entrepreneur's ability to interface with investors because of the risk of violating federal security laws by having their interactions with investors being viewed as a general solicitation or advertisement. HALOS would lift this burden and is an important step to continuing the success that this committee achieved in the Bipartisan Jobs Act. The Jobs Act made it easier for startup enterprises to market their securities to a larger pool of investors. Unfortunately, while implementing the Jobs Act, the SEC has classified events held by angel investors as general solicitations, requiring entrepreneurs and startups to verify accredited investor status. This jeopardizes the vitality of events like demo days where startups can interact with angel investors and venture capitalists. The HALOS Act will simply ensure that angel funding remains available to startups by defining the term angel investor group and exempting angel investor events from being considered a general solicitation. Once again, I urge my colleagues to support this bipartisan common sense measure. I thank the chairman for holding this markup today, and I yield back the balance of my time.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, this bill unfortunately represents a harmful step backwards for our nation's investors, and I must urge my colleagues to oppose this legislation. Specifically, H.R. 4498 would loosen the rules around how companies raise money in private markets, markets that operate without the benefit of state or SEC oversight. And like too many actions taken by this Congress, it would weaken the rules on the backs of investors who are trying to save to buy a home, save to pay for college or for their children, and save for retirement. So let's recall that under the Jobs Act that we passed in 2012, we opened up the private offerings market governed by an SEC exemption known as Rule 506. Under these changes, Congress allowed for general advertising and solicitation of offerings where previously they were sold privately, only to accredited investors with whom the company had pre-existing relationship. In exchange for allowing companies to widely advertise their securities offerings, I secured a very simple amendment to the Jobs Act, which passed on voice vote. This amendment required companies to take reasonable steps to verify that a purchaser of their stock was an accredited investor, meaning they have enough financial sophistication to contend with the lower levels of investor protection. The thinking behind this requirement was, if you're going to advertise these riskier private offerings, you should check to make sure the buyer has the income and assets they say they have and is, in fact, an accredited investor, rather than rely on self-certification. H.R. 4498 would reverse my sensible amendment. Specifically, the bill would provide that the verification requirement did not apply to sales events, also called demo days, venture fairs, or pitch days that are sponsored by a government entity, a college or a university, a nonprofit organization, or an angel investor group, a trade association, or a venture forum or venture capital association. This would represent a large loophole in the rules. And not only is reversing this verification requirement potentially overbroad and harmful, it is also unnecessary. The SEC has already provided relief to angel investor groups. They simply have to either curate the group of people that attend their event and make sure they have a pre-existing relationship with them, or verify their income and assets at the time of purchase. I think that the investor protections in place right now are very reasonable and still allow for capital formation. In fact, the private market under Rule 506 has now surpassed the public market in terms of the amount of funds that U.S. companies raise. In sum, H.R. 4498 undermines the very modest protections we secured in the Jobs Act and opens the door to potential loopholes and aggressive sales techniques. For example, someone could see a flyer on a college campus for a sales pitch, waltz into the presentation, buy some equity in a risky company, and not even have their income or assets verified. The SEC and state regulators would have no window into these sales beyond a short notification form filed after the sales occurred by the company promoting their offering. For these reasons, I would urge my colleagues to oppose this bill, which I believe will be harmful to our nation's investors. I yield back the balance of my time.
Gentlelady yields back. For what purpose does gentlelady from Missouri seek recognition?
I'd like to move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank Representative Chabot of Ohio for introducing this piece of legislation, as well as my colleagues on the Financial Services Committee, Congressman Hurd of Virginia and Congresswoman Sinema of Arizona, for supporting this legislation through the committee. H.R. 4498, the Helping Angels Lead Our Startups Act, provides an important fix to our securities regulations that removes some friction between entrepreneurs and potential investors that are looking to support startup companies. When we think about angel investing or venture capital, we naturally think of the Silicon Valley tech scene or the financial powerhouse of New York City. However, more and more startups are all across the country are using important changes under the Jobs Act in order to raise financing no matter where they are located. In fact, according to the St. Louis Business Journal, St. Louis, my hometown, has the nation's fastest growing startup scene, with 342% deal growth in 2015 and 33% average growth since 2012. Yet, while St. Louis's startups have experienced tremendous growth recently, small businesses and startups everywhere are still having difficulty in obtaining financing and investment in today's economy at a crucial stage when they are trying to grow and expand. The HALOS Act will make a small change that will make it easier for small businesses to find those vital investments. It would exempt demo days from general solicitation requirements that put a burden on entrepreneurs and that would make it less likely for investors to provide financing. Demo days are extremely important in connecting early-stage entrepreneurs that have innovative new ideas with the investment world that are looking for new opportunities to support. These events allow for needed education to occur, where business owners can highlight their companies to investors and people who can provide other business support and mentoring. Without this piece of legislation, it will make it much more difficult for both parties to even be in the same room, much less ultimately reach an investment deal. For those companies that are not yet ready to go public, it is important that they are given the opportunity to pitch their business ideas to those who are interested in learning more. I urge passage of this bipartisan piece of legislation, Mr. Chairman, and I yield back the balance of my time.
Gentlelady yields back. For what purpose does gentlelady from Arizona seek recognition?
Mr. Chairman, I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. I want to express my appreciation to Mr. Chabot and Mr. Hurt. The three of us have been working together on this bipartisan bill to help entrepreneurs and startup companies create jobs and grow our economy. The HALOS Act provides a clear path for startup businesses to connect with angel investors and venture capitalists through demo days without being subject to onerous verification requirements. Demo days are business plan competitions, startup days, innovation summits, and other public forums that introduce entrepreneurs to potential investors. But because of confusion under current law, small businesses that need equity capital may often forego these events, losing opportunities to meet not only accredited investors, but also students, professors, and business professionals whose input and eventual investment could be invaluable. As we work together to make America more competitive in the new global economy, we need to encourage the growth of innovative startups and job-creating small businesses. This is a common sense bipartisan bill, and I'm committed to working with my colleagues on both sides of the aisle to ensure that startups in my home state of Arizona have the support they need to grow their businesses and create jobs. Thank you, Mr. Chair. I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Arizona seek recognition?
Thank you, Mr. Chairman. I'd like to strike the last word.
Gentleman is recognized for 5 minutes.
Having actually been involved in this and the Jobs Act, this just makes sense if you've actually been in this process. Having been part of a group that has actually sponsored some of these pitch days, and then the confusion of, oh heaven, can we let this person in? Do we need to have them vetted? Are they allowed to hear this? Or can they stand outside the door and listen? I mean, the reality of it is the discussion we're having here is borders on this side of absurd. And with that absurdity, I'd like to actually yield back to Mr. Hurt to correct a couple misconceptions that I've heard already in this discussion.
I thank the gentleman, and we just make a couple of additional points. In 2014, Angels invested approximately $24 billion in over 73,000 startup deals, which I think is certainly, we can all agree, is not insignificant. And when you look at the state of our economy and the pace of our so-called recovery over the last 8 years, it is vital that we do everything that we can. As we charted the way with the Jobs Act, it's vital that we do everything we can to encourage job growth. And we know empirically that it is these small companies, it is these startups where this job growth occurs. Just to correct a couple of questions. The first thing I would say is the SEC's mission, one of the three parts of its mission is obviously investor protection. That's something that this committee takes extremely seriously, and I would urge my colleagues not to be not to be attracted to the argument that somehow this somehow diminishes investor protection. It does not. What it in fact does is simply allow for these demo days to take place without in any way removing the requirement that accredited investors that it does not remove the requirement of the accredited investor. Second thing I would say is, as it specifically relates to the demo days, that it is with very specific exceptions within the bill that these demo days would be allowed to be exempt from the general solicitation rule, and it is for those reasons I would ask that we again support this bill. And I yield back to the gentleman from Arizona.
Thank you, Mr. Hurt. So once again, I believe the point there is when you're making the actual investment, you're still within the accredited investor rules, but to actually hold the demo day, I don't have to vet everyone that's walking by the room. And I think that's actually, yeah, that's actually if you walk through the actual language.
Well, the gentleman yield.
Well, actually, I'm going to yield back to my time.
Gentleman yields back. Is there any further discussion? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4620. The clerk will report the bill which was distributed in advance.
H.R. 4620 to amend the Securities Exchange Act of 1934.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from Arkansas, Mr. Hill, the sponsor of the legislation, for 5 minutes.
Thanks, Mr. Chairman. Appreciate you bringing 4620 to the table today, which provides limited relief from Dodd-Frank's risk retention requirements that are set to take effect in December of this year. And those are affecting prudently underwritten, low-risk commercial real estate loans. Despite the last couple of years of the regulators making efforts to write one set of rules encompassing all different securitized asset types, the rule in its current form does not properly treat commercial mortgage-backed securities, despite feedback, evidence, back testing, including during the financial crisis provided by the industry during this two-year rulemaking process. And as I noted when we had our hearing last week, while more than 85% of residential mortgage-backed securities would qualify for an exemption from their risk retention rules, only 3 to 8% of commercial mortgage-backed securities would currently qualify under the rules proposed by the regulators. That doesn't really make any sense to me, given that it was really the residential market, the housing policy that was at the heart of the crisis, not commercial real estate. Let's also not forget that residential mortgages are underwritten based on borrower characteristics, whereas commercial loans are underwritten based on the asset quality itself and the ability to repay from those asset cash flows. In fact, CMBS loans performed well throughout the financial crisis. In looking at back-tested data from 1997 to 2013, cumulative loss rates for conduit CMBS have been 2.79%, only 25 basis points for single-asset borrower transactions. The bill, as proposed, provides modest relief by exempting single-asset, single-borrower transaction from the risk retention rules. These loans are comprised of single, large mortgage on one asset, like a shopping mall or an office complex, which single lenders typically do not finance. These transactions are transparent, and as I've previously noted, the cumulative loss for the past 20 years or so has only been 25 basis points for these type of properties. The bill also sets out reasonable qualified parameters for the market industry generally. And there are a number of parameters, 10 or so or more, that commercial mortgages have to qualify under in order to meet the risk parameters of a qualified commercial mortgage. This bill touches on just a handful. For example, I've heard some comments that these provisions would exempt interest-only loans, which in truth really are not inherently more risky. In fact, they are in some instances less risky. H.R. 4620 simply makes the parameters reflect the market conditions, not somebody's idea of the market conditions, but actually what's going on out in the conduit market for CMBS product. They still have to meet all the other parameters to be a qualified mortgage and get the exemption. These proposals will not exacerbate expected losses while marginally allowing a few more CMBS issues to qualify under the exemption. This rule is not modified before it goes into effect in December. If it's not modified, borrowers across the country could experience significant reductions in access to credit and unwarranted increases in borrowing costs, reduced liquidity, and could impair economic development and job creation. And I think our members on the committee have seen this distributed to them by state, but I was looking at Arkansas. There are 275 commercial loans covering 360 properties across our state, and they are going to be impacted by this rule. And I would argue that people in secondary markets or tertiary markets like Little Rock or Northwest Arkansas, they don't get access to as much credit from the life insurance industries that typically focus on big urban areas, NFL-type markets for commercial real estate development. So CMBS market is particularly important to tertiary and secondary markets. We should be encouraging capital flows into commercial investment-grade real estate, and in my view, this bill will make a modest contribution to that effort. And with that, Mr. Chairman, I'll yield back and listen to the comments of the committee.
Gentleman yields back. For what purposes the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Thank you, Mr. Chairman. The bill we're considering is yet another bill that requires supporters to ignore the financial crisis of 2008, ignore the complete failure of the residential mortgage-backed securities market, ignore the broad devastation it brought to our economy, and ignore the millions of Americans who lost their homes. Instead, supporters just say, oh, but commercial real estate is different. We won't have those problems. It can't possibly happen in this market. Mr. Chairman, I've been around long enough to know foolishness when I see it. The residential mortgage-backed securities market may have been the cause of the last crisis, but don't forget that it was the concerns about the credit quality of Lehman Brothers CRE loan warehouse that directly led to Lehman's bankruptcy. New York Fed economists found that investors' aversion to CMBS created steadily from 2007 and reached staggering proportions in late 2008. It reflected anxiety over a possible rapid increase in commercial mortgage loan defaults driven by the decline in credit standards and high leverage of many properties in CMBS loan pools, as well as the potential for a severe economic downturn. I don't know about you, but that sounds awfully similar to the RMBS market. In fact, new CMBS all but disappeared between 2008 and 2009 as investors fled this market. And why? Because investors learned that the underlying commercial mortgages were poorly underwritten with excessive leverage and unrealistic appraisals. You see, the financial crisis did not just expose the weaknesses of the residential mortgage-backed securities model, but the entire process of securitization. Every asset-backed security, including the CMBS, can fall into the trap of originate to distribute, whereby a lender makes a loan without regard to whether the borrower can repay because the loan is packaged up and sold to unsuspecting investors. In passing Dodd-Frank, Congress realigned the market incentives by requiring either the lender or the securitizer to have skin in the game, to retain some of the credit risk. By retaining a portion of the credit risk, the securitizer would be concerned with the quality of the loans because real money was at stake. Dodd-Frank also recognized that if a security was backed by only the most pristine loans, then the investors could be confident that the lender and securitizer did not pull a fast one. This bill, however, seeks to eliminate the risk retention requirements by eliminating the gold standard for commercial real estate loans carefully crafted by the regulators. Instead, the bill would expand the category to include interest-only loans, remove the term requirements, lengthen amortization requirements, and remove restrictions designed to limit the industry's use of unrealistic appraisals. Sounds so familiar. By making these changes, the gold standard loses its shine and puts the CMBS investors at risk. The regulators considered and rejected each of the proposals included in this bill because they are not in the public interest, and I absolutely agree. So, I urge members not to undermine Dodd-Frank and to oppose this bill, and I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from Arizona seek recognition?
Thank you, Mr. Chairman. Strike the last word.
Gentleman is recognized 5 minutes.
Would my good friend, Mr. Hill, be willing to entertain a little bit of a colloquy here because of your expertise?
With pleasure, I'd be happy.
Representative Hill, your understanding, after 2008, let's actually walk through the different categories of securitization that are on the top of my head. Floor plan. Did floor plan collapse after 2008?
No.
How about automobile?
No.
Securitization of credit card debt?
No.
Okay, how about the categories of commercial loans, CMBS?
Well, under this rulemaking, it's, in my judgment, it's going to be cut back severely.
But it's going to, this is going to shrink it under the rule sets. But if I look at post-2008, now we remember, for those of us who are around this particular business before getting elected here, we were looking at, and we would see the articles saying, oh, this is coming, this is coming. But isn't CMBS have the unique quality of it's underwritten by its income generation, not by someone's individual credit worthiness. It's not on your FICO score, it's on the income produced from that piece of real estate.
No, it's strictly on the commercial real estate itself. So the quality of the building, the location of the building, and the cash flow and historical performance of the building.
The cash flow, that's what I was saying. And look, we have a side discussion I'd like to have with you and the committee that those of us who were in the pooling business, we bought, I represented a couple groups and ran a couple funds that bought actually hundreds and hundreds and hundreds of single-family homes, and turn them into an income-producing asset. And I actually believe if securitized by its income and those things, it should also fall into this category. But also, CMBS has uniquenesses in its reps and warrants on a trustee status and those things on how you unwind it if there is a problem in the control and the cleanup status, right?
They do, and of course, this is, again, you're looking at institutional product that's underwritten and for institutional investors. So this is a very sophisticated, large market for insurance companies play in this market and other institutional investors that are typical buyers of long-term mortgage interests in commercial real estate products.
Yeah, and like on my residential side, I now see the BlackRocks and others who are now putting hundreds of millions of dollars and I guess also trying to create securitized bonds by its cash flow. And thank you for playing along, Mr. Hill. The point I'm making is real simple. Commercial securitizations, different types of reps and warrants than an MBS. You have cash flow and building qualities and those things that are part of the underwriting. It's not an individual's credit report. And it has a unique way, or excuse me, a different way of unwinding if there's an impaired asset. And that's actually why it held up so incredibly well, even when we were seeing commercial vacancies going up and even rent going flat. It did not blow up any markets because the way it's structured differently. And I don't know why we, around here, when we have these sorts of discussions, that we conflate residential MBS with all these other categories of securitization. If we want to look at 2008, let's look at 2008. What held up and what didn't? And those things that held up, let's give them credit for that. And Mr. Chairman, with that, I yield back.
Gentleman yields back. For what purpose? Gentleman from Texas seek recognition.
Move to strike the last word.
Gentleman's recognized for 5 minutes.
Well, thank you, and I want to thank the gentleman for his thoughtful piece of legislation here. I think one of the things that I keep hearing about 2008 and what caused the meltdown in the financial market, and the truth of the matter is, we never, as a Congress, had those discussions. We didn't go back and really do the work that we should have done about, you know, what did cause the meltdown, where were the failures. Had we done that, we would have written a totally different piece of legislation, but instead of doing our work that the American people sent us here to do, we just threw a big blanket over the whole financial markets and pretended like that Congress knows best how to operate these markets, and we called that Dodd-Frank. And so I want to commend the gentleman for this. You know, one of the things that this, if you leave it the way it is now, everybody, you know, talks about big banks. What this makes is it makes the big banks get bigger, because when you start underwriting these large credits like that, and you've got a risk retention requirement on those, then only the very large financial institutions, and so your medium-sized and regional banks in Arkansas can't play in that field for very many deals because of the risk retention requirement. As the gentleman from Arizona said, these credits are much different than residential mortgages, backed securities. These are backed by the assets and the cash flows and the tenant, particularly of the shopping center or the commercial property. And so I just beg to disagree with the ranking member on we know what caused the 2008 crisis. We don't know what caused it because we didn't have those discussions. And so with that, did the chairman want me to yield?
Would the gentleman yield?
No, I would yield to Mr. Hill. Yeah.
Well, I thank the gentleman from Texas, and I would just again argue that this is just modifying slightly the risk retention rules. Can we bring those up on the screen? There are, if I can just go through these, and I'd like to enter them in the record, ask unanimous consent to enter them in the record.
Without objection.
So the ability to repay, for example, we are talking about changing the 10-year minimum that the regulators have proposed to no defined minimum. And in fact, you know, maturities between 5 and 7 years actually have a lower default rate, a better performance rate than the 10-year maturity. And this is reflecting what the industry has out in the CMBS market. Likewise, amortization, it simply makes it 30 years or less. Go to the next page, please. Loan to value, there was a comment made, and we've talked about interest-only loans. This is not like a home loan. This is a commercial mortgage. And again, you can see actually enhanced performance on interest-only loans, and it's tied to the loan to value. And this is so different from the residential market, we need to emphasize it. This is for a property with a 65% loan to value, for example. And so that is the offset. You're trading off low loan to value for being able to have in a structure interest only on a commercial mortgage. Want to go to the next one? We're still complying with appraisals, environmental risk assessment. Next. Security issues, internal controls, the covenant issues. None of this is proposed to be changed from the regulator's proposal. Next. Prohibitions, additional prohibitions. So again, these can be entered in the record and members can study them, but this bill is really a modest change and reflects, as I say, the market conditions for these securities. Now, the ranking member also mentioned 08, and the commercial mortgage-backed securities market has changed quite a bit from the 2000s. Lower leverage. Nearly twice the levels of subordination at the deal level, fewer loans in each proposal, more transparency, no derivative buyers. And so when you combine the market changes plus the rulemaking change and the actions of this bill, I think we do have a prudent market that reflects appropriate conditions. I yield back.
Gentleman from Texas yields back. Does any other member seek time? There being no further... Okay, go ahead. Yeah, go ahead. There being no further discussion or... For what purpose
French Hill's legislation?
Yes.
I would seek time, Mr. Chairman.
Okay. Gentleman from California moves to strike the last word. Gentleman's recognized for 5 minutes.
Thank you, Chairman. I appreciate that. And I also appreciate French Hill's work here on this legislation. You know, for us in California, this is a critical industry. The reality is that commercial real estate in the U.S. is a $3.5 trillion market, and a drying up of liquidity in the commercial mortgage-backed securities market is really going to mean a lot less in terms of expansion, whether it's malls or movie theaters or restaurants or offices, hotels. All of that means fewer jobs as that constriction occurs. And as we heard in this committee last week, securitization isn't just needed for the delivery of commercial real estate capital. It's also integral to the broader macroeconomic growth we need in this economy. The Dodd-Frank Act applied a one-size-fits-all risk retention requirement for single asset, single borrower securities that simply does not make sense for the investments that are easy to understand and easy to underwrite and evaluate. And this risk retention requirement increases the costs of getting projects off the ground, while it does nothing to increase safety and soundness. This legislation that Mr. Hill is proposing really strikes the proper balance between risk retention and a robust CMBS market. And this narrow legislative fix does not take away from the goal of restoring responsible securitization. Investing in the building site of a single neighborhood mall is a far cry from the behavior that brought about the financial crisis, and it should not be treated as such. So I commend our friend, Mr. French Hill, for his work and urge my colleagues on both sides of the aisle to please support this bill. And with that, Chairman, I yield back.
Gentleman yields back. Anybody else seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it, and the ayes have it. Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. Sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Now, pursuant to notice, I call up H.R. 4638. The clerk will report the bill which was distributed in advance.
H.R. 4638 to amend the Securities Exchange Act of 1934 to allow for
Without objection, the
creation
bill
of-
is considered read and open to amendment at any point. The chair recognizes the gentleman from New Jersey, Mr. Garrett, to offer an amendment in the nature of a substitute. Does the gentleman have his amendment at the desk?
It should be.
Copies of the amendment, I have been informed, have been distributed and are on the dais. The clerk will report.
Amendment in the nature of a substitute offered by Mr. Garrett. Strike all after the
Without
enacting
objection, the
clause.
amendment is considered read and will serve as base text for purposes of amendment. The gentleman is recognized for 5 minutes.
Thanks. Thanks, Mr. Chairman. So I believe there's been broad agreement today and in the past that the Jobs Act of 2012 was a tremendous success. More and more companies have been able to access capital, both private and private channels. According to a recent report from Ernst & Young, 85% of companies that have recently have filed an emerging growth company, EGC, under Title I of the Jobs Act. But you know, while the Jobs Act did a great job to reduce costs related to primary offerings, it did really little to address many of the secondary market trading issues that companies face once they go public. So this committee heard testimony from a number of witnesses over the year regarding how current equity market structure can actually disadvantage, if you will, small public companies, which oftentimes trade in very illiquid markets with little research or interest from the investors. This can ultimately have the effect of decreasing their access to capital and discouraging companies from going public altogether. As David Wild, Chairman and CEO of Wild & Company, put it to our committee last year, small companies are the job creators of our economy, and small companies are started with equity capital. For all the quantitative easing of the Federal Reserve, banks won't lend to small businesses unless we improve their access to equity capital. So why does this matter? Why should Congress be involved in fixing it? Well, there's overwhelming evidence that the majority of job creation in the United States takes place after the company goes public. Actually, it's around 92% of job creation happens after the IPO. So if you consider that, even after the Jobs Act, we now have half the number of public companies. Let me say it again. We now have half the number of public companies in the United States as we did 20 years ago. So you can begin to understand the relation between job creation and the ability of companies to complete a successful IPO. So we have here before us now the Main Street Growth Act. And what does it do? It does about 3 or 4 things. I'll just do 3. It would authorize the creation of a venture exchange, which would be registered as a national security exchange with the SEC, specifically tailored to list the shares of emerging growth companies and companies that issue shares under the newly finalized Reg A+. A venture exchange would be subject to all, this is important, subject to all the existing anti-fraud and investor protection statutes administered by the SEC. And finally, importantly, investors of all stripes would be permitted to invest in companies that list on exchanges, and share in these companies would not be limited to simply the Silicon Valley billionaires or those well-connected. So finally, this new type of exchange would have the effect of democratizing our capital markets even further than it is today. It would help create a much-needed venue for Jobs Act companies to list so that they don't simply die on the vine. This amendment, in the nature of a substitute, makes a number of technical changes, as well as a few other small changes in the underlying bill. And I hope that members on both sides of the aisle support this effort to improve our nation's equity market and help small businesses raise the capital. And with that, I yield back the last 2 minutes.
Gentleman yields back. Who seeks recognition? For what purposes the ranking member seek recognition?
Move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman, it's been 9 months since we first considered this bill in committee. And I like to think that my colleagues, Republican colleagues, have been using that time wisely to understand the past and current venture markets. But the bill before us today tells me that that is not the case. If my Republican colleagues had really done their homework, they would have realized that this bill fails to balance the needs of small companies and their investors in the secondary markets, Specifically, it removes state regulatory oversight over these small companies who are prone to fraud and failure. It threatens to create monopolistic trading rights for venture exchange, risk and market integrity, and it creates additional costs for investors who would have to trade with artificially widened spreads. Had Republicans done their homework, they would have also realized that we should not be making such a sweeping change without a thorough study and analysis of relevant information, like previous efforts to create venture markets here and abroad. And while those efforts failed, as well as existing over-the-counter and exchange models for venture securities, our state securities regulators, the Security Traders Association, the New York Stock Exchange, and the Chamber of Commerce all agree that additional study of the existing venture markets here and abroad is warranted. Moreover, it makes sense for us to first understand the range of recently enacted laws and regulations that make it easier for companies to raise capital. Such laws include the recently implemented Regulation A and crowdfunding rules. I'd also like to remind my colleagues that we just enacted on a bipartisan basis the RAISE Act in December to provide an exemption for privately traded securities among accredited investors. For those reasons, I will offer an amendment to study these issues and urge opposition to H.R. 4638, an ill-conceived attempt to help small businesses to the detriment of investors in these companies. Let me just say, Mr. Chairman, that I think that you have seen on both sides of the aisle real concern about small businesses and access to credit. And we have genuine concerns. And when I talk to those who are, promoting this particular legislation, I said to them, I'd really like to work with you to see what we can do to understand better exactly how this market would work. I indicated to them, and they knew that the SEC had also said they'd like to do more study. I am not rejecting this concept. I'm merely saying that none of us really understand how it would really work. And so I believe that, an amendment that I will offer for an amendment should be given serious consideration. And with that, I'll yield back the balance of my time.
Gentlelady yields back. Who seeks recognition? The chair will recognize himself, just to point out that if it hasn't already been stated, the number of IPOs in the U.S. actually rose due to the Job Act, but so much more needs to be done because the U.S. has recently fell from first place to 12th in small IPO output, behind much smaller economies, and fell to 24 out of 26 developed countries in small IPO output on a GDP-weighted basis, ahead of only Mexico and Brazil. This ought to be unacceptable, again, at a time when our economy limps along, when the economy is not working for working Americans. I salute the gentleman from New Jersey, chairman of our Capital Markets Subcommittee, for getting the SEC, for proposing legislation to get the SEC to do something it already should have done. And as we all know, the SEC conveniently seems to forget that part of its mandate to assist and foment capital formation. And so this is an excellent piece of legislation by the gentleman from New Jersey. I think that appropriately structured venture exchanges can provide a lot more liquidity to our small companies, the lifeblood of the economy, the creator of jobs and hope and opportunity in our economy. I urge all members to adopt. I'd be glad to yield additional time to the gentleman from New Jersey if he needs any. If not, I yield back the balance of my time. I'd be happy to yield to the ranking member.
Mr. Chairman, I was hopeful that you would hear what I was trying to communicate about being interested in this concept, about being interested in what you have rightfully identified as the ability to create capital for these emerging firms. I do believe that rather than pursuing with this bill without having the study that is necessary, that has been indicated by the SEC, you only set it up for failure. It's not going to get to the president's desk. I think we should seriously work together to take this concept, work with the SEC, get the study done, and do something that's real rather than simply sending out a message that we are concerned about emerging companies and capital formation. Get it
Reclaiming
done.
my time, I understand very clearly the ranking member's viewpoint, and this is a matter that has been studied for quite some time at the subcommittee level. I'd yield to the gentleman from New Jersey.
I was not sure whether the gentlelady has an amendment or not, but I'll just commit this. I also can say this. A, I agree with the chairman that the SEC has had 82 years to study it. I'm mindful of the fact that when Barney Frank was sitting in your chair years ago, he said, you know, we should come up with a rule someday for the committee that we just shouldn't have any more studies. And I sort of channeled Barney today, so I sort of agree with that. But that all being said, my commitment is the language that we have here is not set in 100% stone. As we said, we had a manager's amendment just now on stuff, on technical things. And so once we get it forward, I am more than happy to continue to work with you or your staff and our staff to figure out whether there's problematic areas. So that's my commitment to you.
The chair yields back his time. For what purpose does the ranking member seek recognition? We'll pause a moment and allow the amendment to be distributed. The clerk will report the amendment.
Amendment offered by Ms. Waters, strike Section 2 and insert the following.
Without objection, the reading of the amendment is dispensed with, and the gentlelady is recognized on her amendment.
Thank you very much, Mr. Chairman. As I stated before, the statutory creation of a venture capital exchange may be warranted, but before we do so, we should ensure that we have sufficient, reliable data showing, and I'll quote the Chamber of Commerce. The quote is, if venture capital exchanges in other markets are successful, or if changes to the larger system are needed, quote unquote. And as you know, the Chamber and I don't always agree on much of anything. So when you see us agreeing, you should take note. A study seems like a common sense. That's why I have an amendment that would require the SEC to study and report to Congress on the past efforts to create venture exchanges, the effectiveness of existing venture markets, and whether venture exchanges should be provided with additional regulatory relief. This study will help us to understand why over the past 80 years, the 20 regional exchanges that have gone out of business or merged with one another to stay afloat, whether the existing over-the-counter venture market in the U.S. already providing small companies with adequate liquidity for their stocks, and the impact of providing additional regulatory relief for venture exchanges in light of the existing market structure for small company stocks, which has recently been changed through the crowdfunding rules, the Reg A+ rules, and the just enacted RAISE Act. It will also provide us with information that the SEC is currently gathering through its tick-size pilot program. I believe this study will help us make a smart bipartisan decision on whether to create an additional venue for trading venture securities. And let me just say this, I'm really not into the whether mood. I'm into the how mood, how to do it. And so I believe that taking the time to do so, rather than just completely overhauling our U.S. equity market structure, as this bill would do, it is given the recent changes in our markets. For example, we just had our first equity crowdfunded IPO with LEO Motors, a manufacturer of fuel-efficient, affordable cars. After raising $17 million from 6,600 investors on a crowdfunding platform using Reg A+, LEO Motors listed its shares at $12 on the over-the-counter market and OTCQX on February 19th. By the end of February, those shares had quadrupled to $50. Before we hastily create a new statutory exchange model for small companies like LEO Motors, we need to understand what works and what doesn't. Again, let me try and emphasize that I like the concept. I believe there's some value in creating this venture market so that we can have real capital formation for these emerging businesses. Let's understand it. Let's get a great bipartisan effort going, and let's get it done. But I think the study is absolutely necessary, and I will yield back the balance of my time.
Gentlelady yields back. For what purposes? The gentleman from New Jersey seek recognition.
Briefly strike the last word on the amendment.
Gentleman is recognized for 5 minutes.
So if I heard you right, you said you're not in the whether mood, you're in the how. I guess I'm more in the when mode or mood. And I'll go back to one of your favorite people to quote, and that would be Ronald Reagan, who said famously, if not us, who? If not now, when?
That was Jesse Jackson.
Okay. Really? I could make a comment there, but I best not. So, and the question is when? As the chair already said, the SEC was created in 1934. They had 82 years to do this. They have a history of not moving unless Congress acts. We just passed a few weeks back, right? A number of bills, bipartisan bills. Where the ideas come from? Came from the industry stakeholders, the relevant people that had gone through the government small business forum. They had been in that forum year in, year out, year in, year out, and it was the opportunity for the SEC to make note of that and to look at them and do something with them. And the SEC does what most government agency does, is nothing. It's that other old saying, don't just do something, stand there. And that is what we have with the SEC in a protracted period of time. And so I would just urge a no vote on the amendment. We're done with studies. I'm open to discuss other changes to the bill, but let's move on.
Gentleman yields back. I'm sorry, the ranking member seeks recognition for unanimous consent.
Unanimous consent request. I have a letter from the Northern American Securities Administrators Association in opposition to the bill, and the OTC markets in opposition to that. I ask that they be submitted for the record.
Without objection. Is there any further debate on the amendment? Not. The question now occurs on the amendment offered by the ranking member. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay. In the opinion of the chair, the nays appear to have it. The nays have it, and the amendment.
Recorded vote requested.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3, the committee rules for the proceedings on the amendment are postponed. Are there any further amendment or discussion? There being no further amendments, recorded votes on the pending amendment has been postponed. Once that vote is taken, the committee will immediately consider the motion to adopt the amendment, nature of substitute as amended, if amendment, and report the measure. I now, pursuant to notice, call up H.R. 3798. The clerk will report the bill which was distributed in advance.
H.R. 3798 to amend the Securities Exchange Act of 1934.
Without objection, the bill is considered read and open to amendment at any point. The chair recognizes the gentleman from New Jersey, Mr. Garrett, the sponsor of the legislation, for 5 minutes.
Thank you, Mr. Chair. So we spent a lot of time in this committee over the years disagreeing about policy or the role of the government in our financial markets, that's for sure. And all of us on both sides of the aisle have very strong opinions on the issues that our committee deals with, so it's not surprising we don't always see eye to eye, case in point, the last one. The one issue where I've never witnessed much disagreement at all among members of Congress, whether you're a Republican, whether you're a Democrat, is when it comes to preserving the rights of Americans to defend themselves in a fair and impartial trial. Why? This is one of the most fundamental rights, and it's enshrined in our Constitution. And when government agencies take actions that basically chip away, if you will, at that right, all of us, not just that individual defendant, but all of us should step back and step in on behalf of the American citizens to ensure that their rights are not trampled by the federal government. Unfortunately, that's what's been happening over at the SEC recently. See, the SEC has in recent years transformed itself into, well, a veritable judge, jury, and executioner. They do so by bringing more and more enforcement cases before its in-house tribunals, many lack of the same protections as citizens are afforded under Article III courts. This trend has increased dramatically since passage of Dodd-Frank, which for the first time granted the SEC authority to use their in-house forms to bring cases against non-registered individuals. Now, why should the SEC do this? Well, a clear and obvious answer is that because these forms give the SEC a significant home team and home court advantage. See, unlike in federal court, the federal rules of civil procedure and the federal rules of evidence do not apply there. Unlike in federal court, defendants are not afforded a jury of their peers. Unlike in federal court, defendants in administrative proceedings only have 4 months to build a case, while the SEC, if you think about it, has spent years building theirs. And perhaps most importantly, unlike in federal court, the SEC's administrative proceedings violate the Constitution's separation of powers. Why is that? Because every person involved in those proceedings, the commissioners, the administrative law judges, the enforcement staff, all of them are the employees of the very same agency. See, in the last year alone, the SEC has heard repeated criticism of these in-house panels from defendants who feel they were not given due process, and also by former SEC judges themselves, who felt pressure to rule in favor of the commission, and also from former SEC commissioners, and also from U.S. district judges, who find the structure of these panels to be unconstitutional. So how do you think the SEC responded to all that worthy criticism? Perhaps not surprisingly, the SEC proposed extremely modest changes to its administrative proceedings last fall that were mere window dressing and will do very little to protect the rights of the innocent. These changes were so modest that one witness described them to our subcommittee in December. Well, they were a, quote, crawl in the right direction. You see, it's clear that if the SEC is not willing to make substantive changes to its proceedings, Congress then must step in and act. And so we have it today, the Due Process Restoration Act. It provides a very simple way to address the problem. The bill simply says that if a defendant wants to exercise their right to a jury trial, their case can be moved to a federal district court and out of the SEC forum. The bill makes no judgment about the liability in certain cases, and it in no way weakens the ability of the SEC to bring enforcement actions in the first place. All it says is that if somebody wants their day in court, they should have their day in court. I think that's something that every member of this committee can get behind. You know, we live in a time where even the mere announcement of an enforcement action can destroy a person's reputation, his career, even if that person is completely innocent. So depriving someone of a real opportunity to defend themselves against the full force of a federal agency is something that all of us on this committee should reject. We now have the opportunity here to right a fundamental wrong perpetrated by an agency that is within our jurisdiction. And with that, I yield back.
Gentleman yields back. For what purpose does the ranking member seek recognition?
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
Mr. Chairman and members, the Wall Street criminals would love this bill. This bill, the so-called Due Process Restoration Act, is a solution in search of a problem that would hamper the ability of the SEC to protect investors from fraud and abuse in the securities markets. Let me just take a moment to say I understand some of the concerns that my friends on the opposite side of the aisle have with the SEC. It's simply our cop on the block. And I am absolutely amazed at all of the attempts that are being made constantly to undermine the SEC, to underfund the SEC, to have the SEC do benefit analysis on everything. But this one goes much further than I thought Mr. Garrett would go. But here it is. While my Republican colleagues would have you believe that the SEC is unfairly prosecuting Wall Street criminals by bringing actions against them through the administrative process rather than the federal court system, that is simply not the case. First, Congress recognizing the need for our regulatory agencies to quickly stop these bad actors and prevent them from causing further harm, has authorized the use of administrative proceedings. These proceedings have the benefit of conserving valuable agency resources and efficiently resolving enforcement actions which can often drag on for years in the federal court system. And that's what the criminals would like. They would like to have their crimes tied up in the federal court system for years, and this is what this bill would help them do.
Well, the gentlelady...
No, I will not.
Oh.
In the SEC's case, these proceedings are an invaluable tool for protecting investors. For example, the SEC can use its administrative process to obtain a prompt hearing and remedies against a financial advisor who stole millions from his clients, yet remains in the industry every day. Second, the SEC's administrative proceedings are fair for defendants, and as the courts have already found, provide them with sufficient due process. The idea that these proceedings are inherently biased in favor of the SEC is inconsistent with the facts. Indeed, the historical win-loss record for the SEC in the courts and in the administrative forms are comparable. And just last year, the SEC actually fared better in the courts, where it prevailed against 100% of defendants in contested cases, compared with only 70% of defendants in administrative proceedings. If the SEC's administrative proceedings were biased, we should have also expect the SEC to use them more often than the federal courts, but that isn't the case. The SEC brings 70% of contested cases in federal court and chooses a forum that best serves the public interest. As stated by the SEC's Chief Litigation Counsel, any claims of a home court advantage are garbage. What's more, if a defendant does not agree with the decision of the administrative judge, he can appeal to the full commission, and following that to the federal courts. In light of these facts and the importance of administrative proceedings to the protection of investors and our markets, I cannot understand why we would want to discourage their use and cripple the SEC, an already woefully underfunded agency, as this bill would do. H.R. 3798 is simply another example of Mr. Garrett and some of the other Republicans protecting Wall Street criminals over investors and the public. I urge my colleagues to join me in opposing this bill, and I yield back the balance of my time.
Gentlelady yields back. Chair recognizes himself for 5 minutes. Listen very carefully to the ranking member's comments, which I guess can best be summed up as to one is guilty until proven innocent. If you could please pull up the chart again, comparing the administrative court with the district court. This is a due process bill. Every American, I don't care what label you attach to them, deserves to be treated with due process. They ought to have the opportunity to have a trial by jury. They ought to be able to engage in full discovery. They ought to be subject to the rules of evidence. They ought to have more than 4 months to build their defense. And so, again, all we heard from the ranking member is, well, if the SEC is going after you, you must be guilty. Well, no. Where's the justice there? I know the ranking member spoke about, well, the SEC is just the cop on the block. Were it to be so. They're the cop, they're the prosecutor, they're the judge, they're the jury. That's the problem. Thus, the problem. There's no due process there. There's no justice there. Frankly, this is a long overdue piece of legislation. I salute the gentleman from New Jersey for bringing it forward now. We have had such an erosion of our foundational principles within our Constitution. Why do we have an executive branch agency that is simultaneously engaged in not just Article 2 activities, but Article 1 and Article 3? And just because somebody is involved in the banking business or the investment of business, there's now going to be a presumption of guilt? Is that the American justice system? I hope not. I think not. It's not what we believe on our side of the aisle. I mean, people are having to do battle with the great giant, the great Leviathan. How do you deal with the government with all of its power and might being brought against you, and we can't even have these proceedings brought in a federal court from the initiation of these charges? Again, I think that this piece of legislation is long overdue, and I'd be glad to yield additional time to the gentleman from New Jersey if he wishes.
Yeah, just very briefly, you make the point that the ranking member seems to assume that you're guilty until proven innocent. Her opening comments was, Wall Street criminals would love this. What about the Wall Street innocents? What about the people who've done absolutely nothing wrong? Is it your premise that every time a cop, you call him cop on the beat, the SEC, so I'll use that same analogy. Is it your position that every time a cop arrests someone, that person is guilty?
Are you
No,
Are you
you
asking
didn't.
me a question?
No. But it seems that way because they're the cop on the beat. They made, I'll call it an arrest, although it's not the proper terminology, and you're saying they must be guilty. They don't have a right to jury. They don't have a right to federal rules. They don't have the right to federal rules evidence. I don't think that's the case. I think sometimes government makes mistakes, whether it's the SEC or some sort of local law enforcement in some town someplace. Sometimes they arrest the wrong person. Sometimes they bring charges against the wrong person. And the person that's hauled in before the judge should know that his constitutional rights are going to be protected. Now, if you're going to say, that's okay, they never make a mistake, whether it's the SEC or local police or county or state, they never make a mistake, then let's extend this. Let's extend this to the criminal justice system as well and say that these rights should be evaporated. The penalties that can come about from this, as I alluded to before, can be just as devastating. Losing your entire livelihood, losing all of your assets, losing your reputation, losing your ability to ever have a job again in the chosen field that you were trained and worked your entire life. All that is being stripped away in an unconstitutional manner. I seriously thought this would be one area that we would agree. I'll just close on this. You know, we got a letter from the National Association of Criminal Defense Lawyers. It'll be in the record. Here's just one paragraph. Their mission is to ensure justice and due process for all. We encourage at all levels of federal, state, and local government a rational and humane criminal justice policy. In keeping with that mission, we believe that people should have a right to not be potentially exposed to criminal punishment and constantly deprived of their liberty or property without adequate due process. That's what this committee should be doing, Mr. Chairman, in this case. Thank you.
My time has expired. Who seeks recognition? For what purposes? Gentleman from Minnesota seek recognition.
Strike last word.
Gentleman is recognized for 5 minutes.
I'll thank the chairman and ranking member. Yesterday the SEC announced administrative enforcement action against Devon McLean and Janice Ray for running a Ponzi scheme. Yesterday, the SEC announced cease and desist orders against Qualcomm Incorporated for bribing foreign officials in China in violation of the Foreign Corrupt Practices Act. It also fined Mr. Craig Salome about $15,000 for trading on insider information when eBay bought GSI. It barred Joseph Giordano from working in any investment job because he made material false and misleading statements to investors. In short, yesterday the SEC acted through its administrative procedure process, which does include substantial due process to protect investors. And the day before that, and the day before that. Well, they don't always get it right, but the answer certainly is not to gum up the process to the degree that no action can take place within a reasonable amount of time of the offense. In fiscal year 2015, administrative law judges issued 207 initial decisions, held 27 hearings, and ordered civil penalties totaling more than $20 million. All details are posted on sec.gov. Is there anyone, there on that website, anybody can see that the SEC Commission staff do a lot of work to ensure that people in the financial industry have to follow the law. The administrative procedure process is of critical importance to investor protection and to fair, transparent markets. But I don't think this bill today recognizes that. This Due Process Restoration Act will weaken the SEC's ability to keep bad actors from ripping off investors. This bill gives defendants the ability to shop their venue, to avoid cease and desist orders or fines, and to seek out a more favorable venue and more opportunities to delay justice. This bill allows them to avoid appearing before an administrative law judge by going straight to federal courts, and current law allows anyone the right to appeal the judge's ruling to a federal appeals court if they wish. I don't think the current administrative proceedings process is unfair or abusive. It's a delay this bill represents a delay tactic, and I think it should be rejected by members. They know that the federal courts are already under-resourced and overwhelmed. And that in part of the delay is because the Senate refuses to confirm qualified candidates. Nearly a dozen federal district court nominees await votes on the Senate floor. In fact, even the Supreme Court nominee, I think, is going to be delayed because of political chicanery. There are 25 judicial appointments pending in the Judiciary Committee. So sending these cases to federal courts, and a quick review of the SEC's website, we'll see a lot of these cases, is just a way to delay the day of reckoning for people who deserve to be held accountable. This lets fraudsters continue to rip off unwary investors until their day in court comes, which could be 10 years or later. So yesterday, 11 states held presidential primary elections. A strong message from voters in those states was belief that the game was rigged to protect the powerful. This bill is a powerful example of how Wall Street and the financial services industry, with the aid of members of Congress, can rig those rules to the disadvantage of the small investor. Now, we don't need to slow down or gum up the SEC. There is substantial due process in the process already, and we should be acting aggressively to strengthen the SEC's enforcement activity, not weaken it, so that we can restore confidence to investors who enter the investment world warily because they fear that nobody is going to protect them. We should stand with Main Street and oppose this bill. And I'll yield back the balance of my time.
Ranking members recognized for unanimous consent.
Communication from Americans for Financial Reform, signed by Public Citizen Centers for Justice and Democracy, Consumer Action, Consumers for Auto Reliability and Safety, Main Street Alliance, National Association of Consumer Advocates, and the North American Securities Administrators Association Incorporated.
That objection, who seeks recognition? For what purposes, gentlemen from Virginia seek recognition? Gentlemen recognized for 5 minutes.
Thank you, Mr. Chairman. One of the fundamental tenets of the American legal system is the right to defend oneself against charges by the government that affect one's property and one's liberty. Protecting an individual's due process rights has consistently received broad bipartisan support over the years, and I believe that we should continue to protect these rights. And that's exactly what Chairman Garrett's bill does. The Due Process Restoration Act would grant a defendant in an SEC administrative proceeding against whom a cease and desist order and a penalty may be issued the right to terminate the proceeding not later than 20 days after receiving notice of such proceeding. This legislation permits the SEC to bring the same action in federal court against that person who terminated the administrative proceeding and seek the same remedy that might have been imposed. Additionally, this bill raises the burden of proof for cases that remain in the SEC administrative proceedings to a higher, clear, and convincing standard. The SEC is increasingly using its own administrative law judges, as opposed to federal courts, to adjudicate enforcement actions. Publicly available data directly supports this and it's no coincidence that the SEC wins the majority of these cases that come before the SEC judges while achieving a substantially lower success rate in federal court. This isn't about letting bad actors walk the streets. This is about making sure that every person has a fair trial. This is about protecting every American's due process rights, whether they're guilty or not guilty, and it's about having an effective enforcement program that ensures these protections. I'm pleased to support Chairman Garrett's bill, and I urge my colleagues to support it as well. Thank the Chairman, and I yield back. And I yield the balance of my time to the Chairman.
I thank the gentleman for yielding. I was listening to the gentleman from Minnesota who had a similar theme to the ranking member, and that is that somehow this legislation is going to constrain the ability of the SEC to deal with criminal activity, and that not enough criminals would be prosecuted. You know what? We could prosecute probably and put a lot more criminals behind bars if we got rid of the Miranda warnings. We could probably put a whole lot more criminals behind bars if they didn't have a right to legal counsel. We could probably put a whole lot more criminals behind bars if we dispensed by trial by jury. We could probably put a whole lot more criminals behind bars if we allowed every police department in America to set up their own court system that would be manned by lieutenants and sergeants and officers on the beat to serve as prosecutors and judges as jury. Yes, we could do that. And by doing that, we would deny justice to American citizens, and we would absolutely stomp upon the Constitution by doing so. And so, again, I just want to thank the gentleman from New Jersey for this overdue piece of legislation. Yes, it is never a bad day to restore due process.
Will the gentleman yield?
I don't recall the gentlelady yielding to the gentleman from New Jersey when
No,
he
I did
requested
not.
time.
No, this is not Mr. Garrett's time.
I understand that, but if the gentlelady is going to seek time from others, I might suggest she also give it to others as well.
It all depends.
I disincline.
It all depends.
I yield. Time belongs to the
back
gentleman
now.
from Virginia.
May I ask the gentleman to yield?
The gentleman from Virginia has yielded back his time. Who seeks recognition? There being no further discussion or amendments to the bill, the question now occurs on ordering the bill reported favorably to the House. Those in favor?
Chairman, I have an amendment at the desk.
We'll pause for a moment and allow the amendment to be distributed. The clerk will report the amendment.
Amendment offered by Mr. Ellison, page 3, line 7. Strike the quotation mark and final period, insert after.
Without objection, the reading of the amendment is dispensed with. The gentleman is recognized on his amendment.
Thank you, Mr. Chairman. I'd like to thank the ranking member as well. My amendment at the desk is about fairness. There's been a lot of discussion about fairness, so let's talk about some fairness. You know, to quote an old proverb, what's sauce for the goose is sauce for the gander, meaning that if there's an appropriate way to treat one group, then other groups similar situated should receive the similar treatment. The Due Process Restoration Act asserts that if a brokerage firm, investment advisor, or investment company is facing an investigation from the SEC, that defendant should have the right to move their case to federal court. The bill supporters say it's unfair to delay access to federal courts for financial experts regulated by the SEC by making them go through the SEC administrative process first. My amendment states that if the defendant denies her or his clients their day in court, then the defendant forfeits the option to move their case to federal court too. If my amendment is adopted and this bill passes, the defendants would not be able to skip the SEC administrative process and move their case to the federal court if the defendant includes any of the 3 restrictions in his or her investment contracts with clients: mandatory dispute arbitration agreements, restrict the resolution forum of their clients, or 3, prohibit clients from participating in class action lawsuits. It's beyond hypocritical for an investment firm to demand venue choice and then require the clients to sign contracts prohibiting them from having their day in court. So let me explain what's at stake here. When an investor goes to an advisor, she signs a contract. Most of the time, that contract includes mandatory pre-dispute arbitration language. It requires investors to submit any dispute or claim to arbitration. In other words, investors who want financial advice must surrender their right to seek recourse in court or in front of a jury. These agreements are required prior to a dispute even occurring. That means investors are compelled to unconditionally waive their rights even before the facts and circumstances of a dispute are known. In arbitration, the broker chooses the venue. For example, the venue could be in Delaware even if the client and the defendant live in Minnesota. My amendment prohibits firms from requiring an investor to seek legal redress in a location not accessible to them. My amendment also prohibits defendants from exercising the option if their contracts with investors ban class action lawsuits. My amendment is supported by the North American Securities Administrators Association, and let me quote from the NASAA's letter of support for this amendment, which I'd like to submit by unanimous consent.
Without objection.
Quote, ultimately, your amendment will incentivize brokerage and advisory firms to abandon the unfair practice of forcing their customers and clients to consent on a, quote, take it or leave it, quote, basis to mandatory pre-dispute arbitration contracts as a condition of any business relationship. Your amendment will make it clear that firms that want to secure the right to have their cases adjudicated in court must provide the same option for their customers. If you support fairness for the average investor, please support my amendment. Also support my bill, the Investor Choice Act of H.R. 1098, and it has 21 co-sponsors. H.R. 1098 prohibits pre-dispute mandatory arbitration language in investment contracts. And let me share another quote from the NASAA. Quote, investors must have a choice of forum when it comes to resolving disputes with their investment professionals. Investor confidence in fair and equitable recourse is critical to the stability of the securities markets and long-term investments by retail investors, unquote. So we've had a lot of talk about fairness around here. Let's see who really means it. I yield back.
Gentleman yields back. For what purpose does the gentleman from New Jersey seek recognition?
To strike the last word.
Gentleman is recognized for 5 minutes.
So I continue to be astonished by the position that you've taken on the underlying bill, and now with the amendment, which is not on point at all, a comparison of apples and oranges as far as the application goes. The client and the local brokerage houses is a far closer symmetry between the two than between an individual going against the Leviathan, which is the SEC and the federal government with their $1.6 billion law enforcement and budget. So does not apply here at all. 3798 does one simple thing. It ensures fairness and protects substantive rights by enhancing procedural due process for the defendant, who we don't know is whether he's guilty or not at the SEC enforcement actions, so that you don't have a judge, jury, and executioner all in one place. I go back to Mr. Ellis's earlier comment about we don't want to gum things up. How often is it when you turn on the evening news and you see some area where there's crime in the neighborhood or something like that, and the police move in quickly, as you would put it, the cop on the beat, they arrest somebody, and there's a bunch of people out there saying, well, don't gum this up. Let it happen right away. Let's throw out the hearsay rule. Let's throw out some of the other rules as far as the evidence. Don't give that defendant the opportunity to have complete discovery so he knows exactly what the cop on the beat has against him. Let the government have the upper hand in all those areas. I thought we were beyond that. thought we understood, as the chair said, you're presumed innocent until proven guilty. If we went back over the transcripts here, what were the comments? Wall Street criminals would love this. And both of you made that reference. The presumption from you is anytime the government steps in, the person is guilty as charged. That's astonishing. That's sad. We're trying to reestablish fairness here to say that the government doesn't always get it right. We've had debates in this in other areas before where we pointed out the government doesn't get it right, and you've pointed that out on various other topical areas. Well, I'm agreeing with you, but we don't deal with all those other areas. We do deal with the SEC. And we can make sure that that person has his day in court, that he has a trial by jury, that he can actually learn what the government is going to present in the case, can have the depositions, go through the regular rules of civil procedure, have the right to appeal to the appellate courts, have the time to actually get the case ready. I don't know if you've ever prepared cases. I have.
Okay, I spent 20 years preparing cases. I guarantee you I tried many more than you have.
I'm sure you have. But the defendant in those cases sure the heck should have a... Let me throw that out to you.
It's the difference between a criminal and a civil matter.
Yeah.
The time belongs to the gentleman from New Jersey.
Have you spent 5 minutes in law school?
As I said,
Both members, all members are reminded to address their comments to the chair. The time belongs to the gentleman from New Jersey.
the devastating impact on the individual in a civil matter can equate or be greater than in certain criminal matters. When you lose your house, your business, your car, all your assets, when your livelihood is destroyed, when your reputation is destroyed, you shake your head no. To that innocent individual, that is devastating. We're just trying to provide fairness, a level playing field, if you will, just the opportunity. And that's what the underlying bill does, and that's what this amendment strips it of the ability to do. And with that, I yield back.
Gentleman yields back. For purposes of ranking members, seek recognition.
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
First, before I talk about the amendment, I'd just like to say that if Mr. Garrett knows anything about my history, he would understand that I've been involved for years in fighting for justice in the criminal justice system, for those who don't have money for fancy lawyers, those who are led into plea bargains that are unfair, on and on and on. So, to question my credibility on whether or not I believe in fairness and justice just leads me to believe that you really don't know or understand much about those of us who have been in this struggle for years for everybody. But we're talking about a little bit something different here. I applaud my colleague for pointing out the Republican hypocrisy of this bill. As I noted earlier, H.R. 3798 seeks to protect Wall Street criminals from a fair and efficient administrative process by allowing them to select the form that benefits them the most. For my colleague from New Jersey to conclude that somehow, because the government has a role and a responsibility in hearing from those who are accused, that somehow we have jumped to the conclusion that they're guilty. And I don't know how he got to that point, because it's not logical. While the SEC chooses whether to bring a case in federal court or in its administrative courts based on the public interest, a well-funded defendant can opt to have his case tried in federal court because the significant delays would allow him to continue his fraudulent business of upwards of 10 years. If Republicans are concerned about sufficient access to the court system, they should focus on a real injustice, such as mandatory arbitration clauses for consumers in their contracts for financial products and services. These clauses, which cover tens of millions of consumers, act to restrict relief in disputes with financial firms, blocking class action lawsuits that provide millions of dollars in redress a year. What this means is that if you are harmed, no matter how many others are harmed with you, a financial services company can force you to proceed against them individually at your own expense. Even worse, if you win against the company may still continue its illegal and harmful behavior against other consumers. According to the Consumer Financial Protection Bureau, which has studied this injustice, most consumers are not even aware of the existence and the effect of these clauses that are typically present in any contract for a financial product, such as a credit card, a checking account, or a payday loan. And while some have argued that arbitration clauses lower costs for companies who can pass along those cost savings to consumers, that is not what is happening. According to the CFPB, there is no statistically significant evidence that the companies that eliminated their arbitration clauses increase their prices or reduce access to credit relative to those that made no change in their use of arbitration clauses. So, I want to thank Mr. Ellison for bringing this up, because this is a serious problem that we're having. And if you want to talk about fairness, if you want to talk about justice, and particularly if you're at all concerned about consumers rather than some of those who find themselves on Wall Street being judged about the actions that they have taken, you would concentrate on these mandatory arbitration clauses for the consumers, for the least of these, for people who can't afford lawyers, on and on and on, and people who simply sign on the dotted line for a job or a contract, not even knowing that these arbitrary clauses are mandatory arbitration clauses are present. So I would urge support for my colleague's amendment that would help stop financial companies, the very defendants who may choose their own lawsuit venue under the bill, from limiting relief for consumers through arbitration. I think it's fair. I yield back the balance of my time.
Gentlelady yields back. Chair recognizes himself for 5 minutes to say that the amendment from the gentleman from Minnesota may be germane, but it is certainly not relevant. There are two different matters that are being discussed here. One has to do with mandatory arbitration between two private entities engaged in a transaction that if they differ, they go before a neutral third party, as opposed to one being accused, perhaps wrongfully accused, by the executive branch of the government with the full weight, power, and funding of the Securities and Exchange Commission to be forced into their tribunal. If there was ever a case of apples and oranges, this is it, and justice cries out for any American, even an American engaged in, God forbid, banking or finance, who should be assumed innocent until proven guilty and be given full benefits of due process. So I urge all members to reject the amendment of the gentleman from Minnesota and to vote for the underlying bill of the gentleman from New Jersey.
Chairman yield?
I yield back the balance of my...
Mr. Chairman, would the chairman yield for just a quick response?
For very briefly.
I just think the chairman ought to look into how big the company is compared to the investor. The size, I think, between the investor and the big company is far greater than between some of these institutional players in the government in terms of just dollars and the ability to marshal lawyers.
Reclaiming my time, I appreciate the gentleman's point, but there is only one force in the nation that has legitimate coercion that can take away your freedom, can take away your property, can take away your wealth, and that is the state. And so that is what we are discussing. We are discussing the state. I yield back the balance of my time. Question now occurs on the amendment offered by the gentleman from Minnesota. All those in favor shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Nay, in the opinion of the chair, the nays have it, and the amendment is not adopted.
I ask for a recorded vote.
Recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is so ordered, and pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings on the amendment are postponed. Okay, there being no further amendments, record votes on the pending amendment has been postponed. Once that vote is taken, the committee will immediately consider the motion to report the measure. Before recessing, there is a pro forma matter I wish to take care of, which the ranking member and I have discussed, reached an agreement on. Without objection, the committee is authorized to enter into a consulting contract with Mr. Dennis Teddy. The chair wishes to advise all members that we will reconvene at 4 p.m. Today to vote on postponed matters. The committee now stands in recess. The committee will come to order. We'll now resume our consideration of pending matters. I now call up H.R. 2901. The clerk will designate the bill by title.
H.R. 2901 to amend the Flood Disaster Protection Act of 1973 to require that certain buildings and personal property be covered by flood insurance and for other purposes.
An amendment in the nature of a substitute offered by Mr. Ross of Florida was adopted by voice vote. The question is now on reporting the bill H.R. 2901 as amended favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. King, aye. Mr. Royce.
Aye.
Mr. Royce, aye. Mr. Lucas.
Aye.
Mr. Lucas, aye. Mr. Garrett.
Aye.
Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Mulvaney. Mr. Hultgren. Mr. Hultgren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, aye. Mrs. Maloney. Mrs. Maloney, aye. Ms. Vasquez. Ms. Vasquez, aye. Mr. Sherman. Mr. Sherman, aye. Mr. Meeks. Mr. Meeks, aye. Mr. Capuano. Mr. Capuano, aye. Mr. Hinojosa. Mr. Clay. Mr. Lynch. Mr. Lynch, aye. Mr. Scott. Mr. Scott, aye. Mr. Green. Mr. Green, aye. Mr. Cleaver. Mr. Cleaver, aye. Ms. Moore. Ms. Moore, aye. Mr. Ellison. Mr. Ellison, aye. Mr. Perlmutter. Mr. Perlmutter, aye. Mr. Himes. Mr. Himes, aye. Mr. Carney. Mr. Carney, aye. Ms. Sewell. Ms. Sewell, aye. Mr. Foster. Mr. Foster, aye. Mr. Kildee. Mr. Kildee, aye. Mr. Murphy. Mr. Murphy, aye. Mr. Delaney. Mr. Delaney, aye. Ms. Cinema. Ms. Cinema, aye. Mrs. Beatty. Mrs. Beatty, aye. Mr. Heck. Mr. Heck, aye. Mr. Vargas. Mr. Vargas, aye. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 53 and the nays are 0.
The majority having voted in favor of the bill as amended, the bill The majority having voted in favor of the bill as amended, the bill is, as amended, is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 2121. The clerk will designate the bill by title.
H.R. 2121 to amend the Safe Mortgage Licensing Act of 2008 to provide a temporary license for loan originators transitioning between employers and for other purposes.
An amendment in the nature of a substitute offered by Mr. Stivers of Ohio was adopted by voice vote. The question is now on reporting the bill H.R. 2121 as amended favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. King, aye. Mr. Royce.
Aye.
Mr. Royce, aye. Mr. Lucas.
Aye.
Mr. Lucas, aye. Mr. Garrett.
Aye.
Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Mulvaney. Mr. Hultgren. Mr. Hultgren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer? Mr. Emmer, aye. Ms. Waters? Ms. Waters, aye. Mrs. Maloney? Mrs. Maloney, aye. Ms. Vasquez? Ms. Vasquez, aye. Mr. Sherman? Mr. Sherman, aye. Mr. Meeks? Mr. Meeks, aye. Mr. Capuano? Mr. Capuano, aye. Mr. Hinojosa? Mr. Clay? Mr. Clay, aye. Mr. Lynch? Mr. Lynch, aye. Mr. Scott? Mr. Scott, aye. Mr. Green? Mr. Green, aye. Mr. Cleaver? Mr. Cleaver, aye. Ms. Moore? Ms. Moore, aye. Mr. Ellison? Mr. Ellison, aye. Mr. Perlmutter? Mr. Perlmutter, aye. Mr. Himes? Mr. Himes, aye. Mr. Carney? Mr. Carney, aye. Ms. Sewell? Ms. Sewell, aye. Mr. Foster? Mr. Foster, aye. Mr. Kildee? Mr. Kildee, aye. Mr. Murphy? Mr. Murphy, aye. Mr. Delaney? Mr. Delaney, aye. Ms. Cinema? Ms. Cinema, aye. Mrs. Beatty? Mrs. Beatty, aye. Mr. Heck? Mr. Heck, aye. Mr. Vargas? Mr. Vargas, aye. Mr. Chairman?
Aye.
Chairman, aye.
Is there any member who has not voted?
Me, Mr. Chairman.
Mr. Duffy?
Aye.
Mr. Duffy, aye.
Is there any other member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will. How's the gentleman from California, Mr. Sherman, recorded?
Mr. Sherman, you're recorded as an aye.
Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 56 and the nays are 0.
Majority having voted in favor of the bill as amended, the bill as amended is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 2896. The clerk will designate the bill by title.
H.R. 2896 to require the federal financial institutions regulatory agencies to take risk profiles and business models of institutions into account when taking regulatory actions and for other purposes.
The question is now on reporting the bill, H.R. 2896, favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. King, aye. Mr. Royce. Mr. Royce, aye. Mr. Lucas. Mr. Lucas, aye. Mr. Garrett. Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Mulvaney. Mr. Hulkren. Mr. Hulkren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Vasquez. Ms. Vasquez, no. Mr. Sherman. Mr. Sherman, no. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Capuano, no. Mr. Hinojosa. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, aye. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Ms. Moore, no. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, aye. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, no. Ms. Sewell. Mr. Sewell, no. Mr. Foster. Mr. Foster, no. Mr. Kildee. Mr. Kildee, no. Mr. Murphy. Mr. Murphy, no. Mr. Delaney. Mr. Delaney, no. Ms. Cinema. Ms. Cinema, no. Mrs. Beatty. Mrs. Beatty, no. Mr. Heck. Mr. Heck, aye. Mr. Vargas. Mr. Vargas, no. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 34 and the nays are 22.
A majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4139. The clerk will designate the bill by title.
H.R. 4139, to amend the Sarbanes-Oxley Act of 2002 to provide a temporary exemption for low-revenue issuers from certain auditor attestation requirements.
The question is now on reporting the bill, H.R. 4139, favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. King, aye. Mr. Royce. Mr. Royce, aye. Mr. Lucas. Mr. Lucas, aye. Mr. Garrett.
Aye.
Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Stutzman, aye. Mr. Mulvaney. Mr. Holcren. Mr. Holcren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, aye. Ms. Velasquez. Ms. Velasquez, no. Mr. Sherman. Mr. Sherman, no. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Capuano, no. Mr. Hinojosa. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, aye. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Ms. Moore, no. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, aye. Ms. Sewell. Ms. Sewell, no. Mr. Foster. Mr. Foster, aye. Mr. Kildee. Mr. Kildee, aye. Mr. Murphy. Mr. Murphy, aye. Mr. Delaney. Mr. Delaney, aye. Ms. Sinema. Ms. Sinema, aye. Mrs. Beatty. Mrs. Beatty, no. Mr. Heck. Mr. Heck, aye. Mr. Vargas. Mr. Vargas, aye. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 42 and the nays are 15.
A majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4166. The clerk will designate the bill by title.
H.R. 4166, to amend the Securities Exchange Act of 1934 to provide specific credit risk retention requirements to certain qualified collateralized loans obligations.
An amendment offered by Mr. Foster of Illinois was adopted by voice vote. The question is now on reporting the bill H.R. 4166 as amended favorably to the House. The clerk will call the roll.
Mr. McHenry. Aye. Mr. McHenry, aye. Mr. King. Aye. Mr. King, aye. Mr. Royce. Aye. Mr. Royce, aye. Mr. Lucas. Aye. Mr. Lucas, aye. Mr. Garrett.
Aye.
Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Stutzman, aye. Mr. Mulvaney. Mr. Holcren. Mr. Holcren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Velasquez. Ms. Velazquez, no. Mr. Sherman? Mr. Sherman, aye. Mr. Meeks? Mr. Meeks, no. Mr. Capuano? Mr. Capuano, no. Mr. Hinojosa? Mr. Clay? Mr. Clay, no. Mr. Lynch? Mr. Lynch, no. Mr. Scott? Mr. Scott, aye. Mr. Green? Mr. Green, no. Mr. Cleaver? Mr. Cleaver, no. Ms. Moore? Ms. Moore, no. Mr. Ellison? Mr. Ellison, no. Mr. Perlmutter? Mr. Perlmutter, no. Mr. Himes? Mr. Himes, aye. Mr. Carney? Mr. Carney, aye. Ms. Sewell? Ms. Sewell, aye. Mr. Foster? Mr. Foster, aye. Mr. Kildee? Mr. Kildee, no. Mr. Murphy? Mr. Murphy, no. Mr. Delaney? Mr. Delaney, aye. Ms. Sinema? Ms. Sinema, aye. Mrs. Beatty? Mrs. Beatty, no. Mr. Heck? Mr. Heck, no. Mr. Vargas? Mr. Vargas, aye. Mr. Chairman?
Aye.
Chairman, aye.
How am I recorded?
Gentleman from New York, how is he recorded?
Mr. Meeks, you're recorded as a no.
I will vote aye.
Mr. Meeks, off no, on aye.
Is there any member has not voted? Is there any other member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 42 and the nays are 15.
The majority having voted in favor of the bill as amended, the bill as amended is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4498. The clerk will designate the bill by title.
H.R. 4498, to clarify the definition of general solicitation under federal securities law.
The question is now in reporting the bill, H.R. 4498, favorably to the House. The clerk will call the roll.
Mr. McHenry? Mr. McHenry, aye. Mr. King? Mr. King, aye. Mr. Royce? Mr. Royce, aye. Mr. Lucas?
Aye.
Mr. Lucas, aye. Mr. Garrett?
Aye.
Mr. Garrett, aye. Mr. Nagelbauer? Mr. Nagelbauer, aye. Mr. Pierce? Mr. Pierce, aye. Mr. Posey? Mr. Posey, aye. Mr. Fitzpatrick? Mr. Fitzpatrick, aye. Mr. Westmoreland? Mr. Lukemeyer? Mr. Lukemeyer, aye. Mr. Huizenga? Mr. Huizenga? Mr. Huizenga, aye. Mr. Duffy? Mr. Duffy, aye. Mr. Hurt? Mr. Hurt, aye. Mr. Stivers? Mr. Stivers, aye. Mr. Fincher? Mr. Fincher, aye. Mr. Stutzman? Mr. Stutzman, aye. Mr. Mulvaney? Mr. Hulkren? Mr. Hulkren, aye. Mr. Ross? Mr. Ross, aye. Mr. Pittenger? Mr. Pittenger, aye. Mrs. Wagner? Mrs. Wagner, aye. Mr. Barr? Mr. Barr, aye. Mr. Rothfuss? Mr. Rothfuss, aye. Mr. Messer? Mr. Messer, aye. Mr. Schweikert? Mr. Schweikert, aye. Mr. Ginta? Mr. Ginta, aye. Mr. Tipton? Mr. Tipton, aye. Mr. Williams? Mr. Williams, aye. Mr. Poliquin? Mr. Poliquin, aye. Mrs. Love? Mrs. Love, aye. Mr. Hill? Mr. Hill, aye. Mr. Emmer? Mr. Emmer, aye. Ms. Waters? Ms. Waters, no. Mrs. Maloney? Mrs. Maloney, no. Ms. Velazquez? Ms. Velazquez, no. Mr. Sherman? Mr. Sherman, no. Mr. Meeks? Mr. Meeks, aye. Mr. Capuano? Mr. Capuano, no. Mr. Hinojosa? Mr. Clay? Mr. Clay, no. Mr. Lynch? Mr. Lynch, no. Mr. Scott? Mr. Scott, no. Mr. Green? Mr. Green, no. Mr. Cleaver? Mr. Cleaver, aye. Ms. Moore? Ms. Moore, no. Mr. Ellison? Mr. Ellison, no. Mr. Perlmutter? Mr. Perlmutter, aye. Mr. Himes? Mr. Himes, aye. Mr. Carney? Mr. Carney, aye. Ms. Sewell? Ms. Sewell, aye. Mr. Foster? Mr. Foster, aye. Mr. Kildee? Mr. Kildee, no. Mr. Murphy? Mr. Murphy, aye. Mr. Delaney? Mr. Delaney, aye. Ms. Sinema? Ms. Sinema, aye. Mrs. Beatty? Mrs. Beatty, aye. Mr. Heck? Mr. Heck, no. Mr. Vargas? Mr. Vargas, aye. Mr. Chairman?
Aye.
Mr. Chairman, aye.
Is there any member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 44 and the nays are 13.
A majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4620. The clerk will designate the bill by title.
H.R. 4620 to amend the Securities Exchange Act of 1934 to exempt certain commercial real estate loans from risk retention requirements and for other purposes.
The question is now on reporting the bill, H.R. 4620, favorably to the House. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Mr. King, aye. Mr. Royce. Mr. Royce, aye. Mr. Lucas. Mr. Lucas, aye. Mr. Garrett. Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Stutzman, aye. Mr. Mulvaney. Mr. Hultgren. Mr. Hultgren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Velasquez. Ms. Velasquez, no. Mr. Sherman. Mr. Sherman, no. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Capuano, no. Mr. Hinojosa. Mr. Clay. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, aye. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Ms. Moore, no. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, aye. Ms. Sewell. Ms. Sewell, no. Mr. Foster. Mr. Foster, aye. Mr. Kildee. Mr. Kildee, aye. Mr. Murphy. Mr. Murphy, aye. Mr. Delaney. Mr. Delaney, aye. Ms. Sinema. Ms. Sinema, aye. Mrs. Beatty. Mrs. Beatty, no. Mr. Heck. Mr. Heck, no. Mr. Vargas. Mr. Vargas, aye. Mr. Chairman.
Aye.
Chairman, aye.
Is there any member who has not voted? Is there any member who wishes to change his or her? Yes, gentleman from Michigan. How is the gentleman from Michigan recorded?
Mr. Kildee, you're recorded as aye. Mr. Kildee, off aye, on no.
Is there any other member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 39 and the nays are 18.
The majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 4638. The clerk will designate the bill by title.
H.R. 4638 to amend the Securities Exchange Act of 1934 to allow for the creation of venture exchanges to promote liquidity of venture securities and for other purposes.
Committee will come to order. The question now occurs on agreeing to the amendment offered by the gentlelady from California, the ranking member, Ms. Waters, on which a recorded vote was ordered. The clerk will call the roll.
Mr. McHenry.
Aye.
That's a no.
I'm sorry.
Mr. McHenry, no. Mr. King.
I'll follow Mr. Kennedy. No.
Mr. King, no. Mr. Royce. Is he up there? Mr. Lucas.
No.
Mr. Lucas, no. Mr. Garrett.
No.
Mr. Garrett, no. Mr. Nagelbauer. Mr. Nagelbauer, no. Mr. Pierce. Mr. Pierce, no. Mr. Posey. Mr. Posey, no. Mr. Fitzpatrick. Mr. Fitzpatrick, no. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, no. Mr. Huizenga. Mr. Huizenga, no. Mr. Duffy. Mr. Duffy, no. Mr. Hurt. Mr. Hurt, no. Mr. Stivers. Mr. Stivers, no. Mr. Fincher. Mr. Fincher, no. Mr. Stutzman. Mr. Stutzman, no. Mr. Mulvaney. Mr. Hultgren. Mr. Hultgren, no. Mr. Ross. Mr. Ross, no. Mr. Pittenger. Mr. Pittenger, no. Mrs. Wagner. Mrs. Wagner, no. Mr. Barr. Mr. Barr, no. Mr. Rothfuss. Mr. Rothfuss, no. Mr. Messer. Mr. Messer, Mr. Schweikert. Mr. Schweikert, no. Mr. Ginta. Mr. Ginta, no. Mr. Tipton. Mr. Tipton, no. Mr. Williams? Mr. Williams, no. Mr. Poliquin? Mr. Poliquin, no. Mrs. Love? Mrs. Love, no. Mr. Hill? Mr. Hill, no. Mr. Emmer? Mr. Emmer, no. Ms. Waters? Ms. Waters, aye. Mrs. Maloney? Mrs. Maloney, aye. Ms. Vasquez? Ms. Vasquez, aye. Mr. Sherman? Mr. Sherman, aye. Mr. Meeks? Mr. Meeks, aye. Mr. Capuano? Mr. Capuano, aye. Mr. Hinojosa? Mr. Clay? Mr. Clay, aye. Mr. Lynch? Mr. Lynch, aye. Mr. Scott? Mr. Scott? Mr. Scott, aye. Mr. Green? Mr. Green, aye. Mr. Cleaver? Mr. Cleaver, aye. Ms. Moore? Ms. Moore, aye. Mr. Ellison? Mr. Ellison, aye. Mr. Perlmutter? Mr. Perlmutter, aye. Mr. Himes? Mr. Himes, aye. Mr. Carney? Mr. Carney, aye. Ms. Sewell? Ms. Sewell, aye. Mr. Foster? Mr. Foster, aye. Mr. Kildee? Mr. Kildee, aye. Mr. Murphy? Mr. Murphy, aye. Mr. Delaney? Mr. Delaney, aye. Ms. Cinema? Ms. Cinema, aye. Mrs. Beatty? Mrs. Beatty, aye. Mr. Heck? Mr. Heck, aye. Mr. Vargas? Mr. Vargas, aye. Mr. Chairman?
No.
Chairman, no.
Is there any member who has not voted?
Madam Clerk, yes, Mr. Chairman.
Who seeks?
Madam Clerk.
Mr. Royce?
Gentleman from California, how is he
He
recorded?
is not recorded.
Royce, no.
Mr. Royce, no.
Is there any other member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 25 and the nays are 32.
The amendment, therefore, is not agreed to. The question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from New Jersey, Mr. Garrett. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes appear to have it. The ayes have it, and the amendment is adopted. The question now occurs on reporting the bill favorably to the House as amended. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion, yes. A recorded vote has been requested. All those in favor of a recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. The clerk will call the roll.
Mr. McHenry? Mr. McHenry, aye. Mr. King? Mr. King, aye. Mr. Royce? Mr. Royce, aye. Mr. Lucas? Mr. Lucas, aye. Mr. Garrett?
Aye.
Mr. Garrett, aye. Mr. Nagelbauer? Mr. Nagelbauer, aye. Mr. Pierce? Mr. Pierce, aye. Mr. Posey? Mr. Posey, aye. Mr. Fitzpatrick? Mr. Fitzpatrick, aye. Mr. Westmoreland? Mr. Lukemeyer? Mr. Lukemeyer, aye. Mr. Huizenga? Mr. Huizenga, aye. Mr. Duffy? Mr. Duffy, aye. Mr. Hurt? Mr. Hurt, aye. Mr. Stivers? Mr. Stivers, aye. Mr. Fincher? Mr. Fincher, aye. Mr. Stutzman? Mr. Stutzman, aye. Mr. Mulvaney? Mr. Holgren? Mr. Holgren, aye. Mr. Ross? Mr. Ross, aye. Mr. Pittenger? Mr. Pittenger, aye. Mrs. Wagner? Mrs. Wagner, aye. Mr. Barr? Mr. Barr, aye. Mr. Rothfuss? Mr. Rothfuss, aye. Mr. Messer? Mr. Messer, aye. Mr. Schweikert? Mr. Schweikert, aye. Mr. Ginta? Mr. Ginter, aye. Mr. Tipton? Mr. Tipton, aye. Mr. Williams? Mr. Williams, aye. Mr. Poliquin? Mr. Poliquin, aye. Mrs. Love? Mrs. Love, aye. Mr. Hill? Mr. Hill, aye. Mr. Emmer? Mr. Emmer, aye. Ms. Waters? Ms. Waters, no. Mrs. Maloney? Mrs. Maloney, no. Ms. Vasquez? Ms. Vasquez, no. Mr. Sherman? Mr. Sherman, no. Mr. Meeks? Mr. Meeks, aye. Mr. Capuano? Mr. Capuano, no. Mr. Hinojosa? Mr. Clay? Mr. Clay, no. Mr. Lynch? Mr. Lynch, no. Mr. Scott? Mr. Scott, no. Mr. Green? Mr. Green, no. Mr. Cleaver? Mr. Cleaver, no. Ms. Moore? Ms. Moore, no. Mr. Ellison? Mr. Ellison, no. Mr. Perlmutter? Mr. Perlmutter, no. Mr. Himes? Mr. Himes, no. Mr. Carney? Mr. Carney, no. Ms. Sewell? Ms. Sewell, no. Mr. Foster? Mr. Foster, no. Mr. Kildee? Mr. Kildee, no. Mr. Murphy? Mr. Murphy, no. Mr. Delaney? Mr. Delaney, no. Ms. Cinema? Ms. Cinema, no. Mrs. Beatty? Mrs. Beatty, no. Mr. Heck? Mr. Heck, no. Mr. Vargas? Mr. Vargas, no. Mr. Chairman?
Aye.
Chairman, aye.
Is there any member who has not voted?
Mr. Chairman?
How's the gentleman from, yes.
How am I recorded?
Mr. Meeks, you're recorded as an aye.
Nay.
Mr. Meeks, off aye on nay.
Is there any member who has not voted? Is there any other member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 32 and the nays are 25.
A majority having voted in favor of the bill as amended, the bill as amended is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes, and members will have 2 days to file views on the reported measure. I now call up H.R. 3798. The clerk will designate the bill by title.
H.R. 3798 to amend the Securities Exchange Act of 1934 to permit private persons to compel the Securities and Exchange Commission to seek legal or equitable remedies in a civil action instead of an administrative proceeding and for other purposes.
Committee will come to order, please. The question now occurs on agreeing to the amendment offered by the gentleman from Minnesota, Mr. Ellison, on which a recorded vote was ordered. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, no. Mr. King. Mr. King, no. Mr. Royce. Mr. Lucas. No. Mr. Lucas, no. Mr. Garrett.
No.
Mr. Garrett, no. Mr. Nagelbauer. Mr. Nagelbauer, no. Mr. Pierce. Mr. Pierce, no. Mr. Posey. Mr. Posey, no. Mr. Fitzpatrick. Mr. Fitzpatrick, no. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, no. Mr. Huizenga. Mr. Huizenga, no. Mr. Duffy. Mr. Duffy, no. Mr. Hurt. Mr. Hurt, no. Mr. Stivers. Mr. Stivers, no. Mr. Fincher. Mr. Fincher, no. Mr. Stutzman. Mr. Stutzman, no. Mr. Mulvaney. Mr. Hulkren. Mr. Hulkren, no. Mr. Ross. Mr. Ross, no. Mr. Pittenger. Mr. Pittenger, no. Mrs. Wagner. Mrs. Wagner, no. Mr. Barr. Mr. Barr, no. Mr. Rothfuss. Mr. Rothfuss, no. Mr. Messer. Mr. Messer, no. Mr. Schweikert. Mr. Schweikert, no. Mr. Ginta. Mr. Ginta, no. Mr. Tipton. Mr. Tipton, no. Mr. Williams. Mr. Williams, no. Mr. Poliquin. Mr. Poliquin, no. Mrs. Love. Mrs. Love, no. Mr. Hill. Mr. Hill, no. Mr. Emmer. Mr. Emmer, no. Ms. Waters. Ms. Waters, aye. Mrs. Maloney. Mrs. Maloney, aye. Ms. Vasquez. Ms. Vasquez, aye. Mr. Sherman. Mr. Sherman, aye. Mr. Meeks. Mr. Meeks, aye. Mr. Capuano. Mr. Capuano, aye. Mr. Hinojosa. Mr. Clay. Mr. Clay, aye. Mr. Lynch. Mr. Lynch, aye. Mr. Scott. Mr. Scott, aye. Mr. Green. Mr. Green. Mr. Green, aye. Mr. Cleaver. Mr. Cleaver, aye. Ms. Moore. Ms. Moore, aye. Mr. Ellison. Mr. Ellison, aye. Mr. Perlmutter. Mr. Perlmutter, aye. Mr. Himes. Mr. Himes, aye. Mr. Carney. Mr. Carney, aye. Ms. Sewell. Ms. Sewell, aye. Mr. Foster. Mr. Foster, aye. Mr. Kildee. Mr. Kildee, aye. Mr. Murphy. Mr. Murphy, aye. Mr. Delaney. Mr. Delaney, aye. Ms. Sinema. Ms. Sinema, aye. Mrs. Beatty. Mrs. Beatty, aye. Mr. Heck. Mr. Heck, aye. Mr. Vargas. Mr. Vargas, aye. Mr. Chairman.
No.
Chairman, no.
For what purpose, gentleman from California seek recognition? How's gentleman from California
Mr.
recorded?
Royce, you're not recorded. Mr. Royce, no.
Is there any other member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 25 and the nays are 32.
Therefore, the amendment is not agreed to. The question now occurs on reporting the bill favorably to the House. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, a recorded vote has been requested. All those in favor of recorded vote shall raise their hand and be counted. A sufficient number having raised their hands, a recorded vote is ordered. The clerk will call the roll.
Mr. McHenry. Mr. McHenry, aye. Mr. King. Aye. Mr. King, aye. Mr. Royce. Aye. Mr. Royce, aye. Mr. Lucas. Aye. Mr. Lucas, aye. Mr. Garrett.
Aye.
Mr. Garrett, aye. Mr. Nagelbauer. Mr. Nagelbauer, aye. Mr. Pierce. Mr. Pierce, aye. Mr. Posey. Mr. Posey, aye. Mr. Fitzpatrick. Mr. Fitzpatrick, aye. Mr. Westmoreland. Mr. Lukemeyer. Mr. Lukemeyer, aye. Mr. Huizenga. Mr. Huizenga, aye. Mr. Duffy. Mr. Duffy, aye. Mr. Hurt. Mr. Hurt, aye. Mr. Stivers. Mr. Stivers, aye. Mr. Fincher. Mr. Fincher, aye. Mr. Stutzman. Mr. Stutzman, aye. Mr. Mulvaney. Mr. Hulkren. Mr. Hulkren, aye. Mr. Ross. Mr. Ross, aye. Mr. Pittenger. Mr. Pittenger, aye. Mrs. Wagner. Mrs. Wagner, aye. Mr. Barr. Mr. Barr, aye. Mr. Rothfuss. Mr. Rothfuss, aye. Mr. Messer. Mr. Messer, aye. Mr. Schweikert. Mr. Schweikert, aye. Mr. Ginta. Mr. Ginta, aye. Mr. Tipton. Mr. Tipton, aye. Mr. Williams. Mr. Williams, aye. Mr. Poliquin. Mr. Poliquin, aye. Mrs. Love. Mrs. Love, aye. Mr. Hill. Mr. Hill, aye. Mr. Emmer. Mr. Emmer, aye. Ms. Waters. Ms. Waters, no. Mrs. Maloney. Mrs. Maloney, no. Ms. Velasquez. Ms. Velasquez, no. Mr. Sherman. Mr. Sherman, no. Mr. Meeks. Mr. Meeks, no. Mr. Capuano. Mr. Capuano, no. Mr. Hinojosa. Mr. Clay. Mr. Clay, no. Mr. Lynch. Mr. Lynch, no. Mr. Scott. Mr. Scott, no. Mr. Green. Mr. Green, no. Mr. Cleaver. Mr. Cleaver, no. Ms. Moore. Ms. Moore, no. Mr. Ellison. Mr. Ellison, no. Mr. Perlmutter. Mr. Perlmutter, no. Mr. Himes. Mr. Himes, no. Mr. Carney. Mr. Carney, no. Ms. Sewell. Ms. Sewell, no. Mr. Foster. Mr. Foster, no. Mr. Kildee. Mr. Kildee, no. Mr. Murphy. Mr. Murphy, no. Mr. Delaney. Mr. Delaney, no. Ms. Cinema. Ms. Cinema, no. Mrs. Beatty. Mrs. Beatty, no. Mr. Heck. Mr. Heck, no. Mr. Vargas. Mr. Vargas, no. Mr. Chairman.
Aye.
Chairman, aye.
If members choose to exit, committee will come to order. Committee will come to order. If members exit, please exit quietly. Is there any member who has not voted? Is there any member who wishes to change his or her vote? If not, the clerk will report.
Mr. Chairman, the ayes are 32 and the nays are 25.
A majority having voted in favor of the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes. Members will have 2 days to file views on the reported measure. There being no further business pending, the committee stands adjourned.